Saudi? Do you know how do you know how microphones are tested? Filippo, do you know? 1 million, 2. Hey everyone, thank you for joining us at the business, let's say it lounge. Well, what is it? Business stage. If you want, you can come in closer. A little bit about myself. Give me a second so people can take a seat. For all of those of you watching, thank you for tuning in. We're gonna be up here all day. I'm gonna take you on a wild ride when it comes to Web3 business. Interesting personalities that will come up here. But yeah, a little bit about myself. Been working for more than 15 years plus with trading platforms and different brokers. I was the country lead for OKX Romania, and now I'm doing user acquisition for fintech products, especially for fintech platforms. Take a seat. Cool. So, we're going to have our first speaker, a very interesting and charismatic gentleman. Their product or their project comes from the decentralized finance branch. Very interesting and futuristic. I'll give you Filippo Moraski, hopefully I pronounced it right, Head of Growth at Volks Finance. This is a very important role when it comes to growth. It is a very complex position. Volks Finance is the next generation of DeFi lending. I would say cross-chain monolithic meets vault-based model. So we will have Filippo come in. Filippo, the stage is yours. Thank you all and stay tuned.
Hello everyone, I'm Filippo Moraski and I'm the head of growth for Volks Finance. First of all, it's nice to be back here in this beautiful location. I really like the city. But yes, let's start. It's also nice to kick off the conference. So yes, as I said before, I'm the head of growth for Volks Finance. Volks Finance is a cross-chain DeFi protocol that offers a wide range of decentralized tools, including liquid staking, lending and borrowing, cross-chain swaps, leverage trading, and more. Before moving forward, I would like to clarify and make a distinction of these two terms. When we talk about multi-chain, we refer to a protocol that is deployed and fork on multiple chains, while with cross-chain, we refer to a protocol that can be accessed through multiple chains. The multi-chain system brings several inefficiencies. In my opinion, the two main points that nowadays multi-chain protocols are facing are, the first one is the liquidity fragmentation, and the second one is the tool fragmentation. Why liquidity fragmentation? Because since the protocol is deployed and forked on multiple chains, these chains don't talk between each other. So there is no shared liquidity of the lending pools. While for the tools fragmentation is because if I have a position on one chain, let's say on Avalanche, and I want to bring my collateral or my loan into another chain, the step that I need to take is I need to close the loan, I need to repay the loan, I need to bridge my collateral into another chain, in this case even using another bridging tool. I need to reopen a new loan with new asset in another chain. So as you can see, the UX is not really smooth. The cross-chain architecture really fixed this. Because with the cross-chain system, you can have capital efficiency with shared liquidity, since the liquidity is shared among all the chains, and all the chains are aggregated into a unique infrastructure. There is no bridging, because everything is abstracted using a messaging layer technology. In this case, we are using Chainlink CCP to do the bridging operation. It's called messaging. But yes, for simple terms, we are calling it bridging. There is interoperability between chains because I can deposit an asset one chain, let's say on Ethereum, and I can borrow natively on Arbitrum without having to deal with wrapped asset or bridging operation. And obviously, there is no need of switching networks between chains because it's just a unique interface. One of the most important aspects of the cross-chain capabilities is that allow lending protocol to have concentrated liquidity in the pools. It means that, for example, I'm a USDC lender on Avalanche. There is another USDC lender on Arbitrum. All the liquidity will go into a unique pool, the same for borrowers. If I'm taking out a loan on Solana or I'm taking out a loan on BNB chain, this loan is taken out from the same pool. So this has three main benefits. The first one is you can allow a deeper liquidity, so greater borrowing power for the users. The second benefit is the standardization of the interest rates. Since the pools are not splitted between several chains, but rather they are unified, this allows to have just a unique interest rates. And obviously, it's way better in terms of UX because users can deposit, withdraw, repay, do the operation they prefer from the same asset in the chain they prefer. So, for example, I deposit USDC on Avalanche. I can withdraw it on Monad. I have a borrow of USDC on Ethereum. I can repay from Polygon. So it's really interoperable also on the loan management. Here I'm showing you some comparison between the multi-chain model and the concentrated model by Fox Finance. Here I'm taking as example AVV3 since it's the largest multi-chain model in the landscape. Here, since Aave has several chains that don't talk between each other, here we are assuming that the total USDC liquidity amount is 1 billion. But on Aave, on the multi-chain model, the USDC liquidity is split among so 700 million in all the chains, and 300 million on an Arbitrum. Since the USDC liquidity don't talk between each other in the chains, the maximum borrowable amount that the borrowers can take up is 300 million on Arbitrum. While on Fox Finance concentrated model, since all the liquidity is aggregated into a unique pool, the maximum borrowable amount is 1 billion. So as you can see, the concentrated liquidity model of Fox Finance is way more efficient than a multi-chain model. Nowadays, the land infrastructure. Here I listed three main benefits of each system. The monolithic approach has an higher capital efficiency aggregated since the pool is aggregated within one place and not splitted between all the vault. There's a greater efficiency in the loan management as you can manage your loan as you prefer, so you can withdraw the collateral, you can swap collateral, you can swap the debt, you can repay the loan with any asset, with collateral, with other assets in your wallet, or using a DEX. So there is a higher composability. Bad event in one asset, this will not jeopardize the entire protocol. There is a higher LTV per market, so thanks to the nature that allow one collateral and one borrower, you can enable a higher loan to value, so the maximum borrowable amount against a specific collateral. And yeah, you have also immutable parameters, and this will also ensure the predictable in the market behavior for lenders and borrowers. And this is the vision of Fox Finance V2. The Fox Finance V2 will see a transition from being just a lending protocol to be more an infrastructure layer to allow institution, treasury, banks, asset manager, even other DeFi protocols to build their own lending environment using the Fox Finance stack. So yeah, institution will be able to build their own custom lending environment with custom parameters using the Fox Finance system. The Fox Finance Exchange V2 will leverage the Fox Finance cross-chain capabilities. Fox Finance V2 will support EVM and non-EVM using the unified pools. It will have also Vault cross-chain. There will be personal parameters, so a banks or whatever an asset manager can build their own lending protocol, having the maximum option of parameters, so you can customize by having safe parameters in caps, pools. You can decide the oracle, the liquidation model, the interest rate model. You can decide also whether having privacy tool, KYC, KYB, KYT. So what we will offer is an infinite number of options that will bring the customization and configuration of parameter at the next level, something that doesn't exist yet in the market. And obviously there will be, the protocol will be highly composable, so we'll see a lot of integration, especially also in the PayFi space. Since I already mentioned it, there will be integration in the PayFi area, mobile area. We are seeing nowadays a lot of neobanks that are coming on the market, and given the composability of Fox Finance V2, this will be integrated in many apps. Basically, these are the three categories that Fox Finance will work on it. So the savings, users will be able to just deposit an asset in their mobile app by earning a passive yield on their asset. Everything will be managed by Vault, by Fox Finance Vault. There will be integration with AI, with agents, so users will be able to use AI for payment automation, rebalancing, swaps, monitoring. And also, users will be able to use Fox Finance loans in everyday purchasing. So there will be a credit card backed by the DeFi loans, so I can use this credit card while I'm spending when I'm buying a gelato or I'm paying at the restaurant. I can use my collateral and take out a loan to pay the real good, while I'm earning yield on my collateral. So I'm spending, but at the same time I'm earning yield on my purchases. Final word on the security aspect of Fox Finance is the users' funds is what we care the most, honestly. We invested a lot on it. The way that we approach security is that the protocol has been audited several times. We are also partner of Immunify, which is the leading bug bounty platform in the space. We also we are among the first partner that organize bug bounty hackathon, audit competition that will bring white hat and third-party auditors. And also at the same time, we perform several audit economic review on the mathematical model. So this is an important aspect that, in my opinion, should be the standard of the Web3 space. And obviously, we also have an ongoing bug bounty hackathon, so if there are any white hackers in the room, they can just try to hack the code and grab some prizes. This is it. It was a pleasure. Let me know if you have any question, or I don't know if we have space for question, but yeah, it was a pleasure. Thank you very much for being here.
Thank you, Filippo, for this good presentation. Are there any questions from the audience? There you go. You can stay here, and I'll take the microphone to the gentleman.
Well, thank you. Thank you so much. You mentioned institutional adoption at one point. I am curious how you guys are strategizing over driving that institutional adoption.
So honestly, it's something that we are facing because in the before building Fox Finance V2, our idea was, okay, let's talk before to institution because we want to understand what is their need, what they want to use. So all the institutions told us that they want a custom environment with the higher flexibility in asset configuration. They want to be isolated. They don't want to be jeopardized by external factors. So they really want their own custom lending environment. Even, for example, there are institutions that wants to be on private chain. It's something that Fox Finance which you can allow. So also having privacy tools, allowing different kind of users. So, for example, you can even have credit score-based system, or you can even say, okay, I just want to have also whitelisted liquidators in the market. So this kind of flexibility in the parameters configuration.
Have you seen any mention about structured products at all in your talks with institutions?
What?
Structured products.
What are you referring to?
Well, that's a long topic. It just means that they didn't mention it. So I guess
Okay.
my question is answered. I don't want to take up too much time.
No problem, no problem.
Thank you.
We can discuss it later.
Yeah, we can.
Yeah.
Structured products. Yeah, I think I know what you're talking about, but it is a big topic. I do have a question for you,
Yes, of
Filippo.
course.
How is it to build a product in Europe?
So the team is 80% Italian. We are, I mean, especially in Italy, I'm from Italy, I'm from Milano. There are a lot of people that are working in the Web3 space. There are not many Italian projects. I will say that, for example, the Fox Finance, which you also with the mobile integrations, will focus a lot on also in the emerging markets. Yes, in Europe it's tough because also for regulation will make it is making the DeFi experience not really accessible for users. There are several limits, but compared to other countries. But yes, I mean, at the end we are just code. We have an interface. What we do is developing the code and the user interact regardless of their status. So we are a decentralized product. Everyone can interact with it, can build on top. So
Nice.
at the end, yeah, we are just code and that's it.
Any other questions at this time from the audience? No questions? Well, thank you, Filippo, once again.
Thank you very much.
Great presentation.
See you later.
Thank you. Do you guys, can you hear me? Do you guys smell that? Do you guys smell it? It's money, because this is the business stage, right? So, things are going along. Thank you once again for the Italian team. First product from Italy, as far as I've seen so far. Now, I know Ethereum conferences are towards tech. I'm also from the business side, and this gentleman is amazing. So I would like to personally congratulate him to, to be with us. His bio is very impressive. So basically, I checked the product he's building, and I identified something very cool. Retail traders don't fail from lack of ideas, but from lack of structure. Am I right? This talk actually shows how AI can turn vague trading intents into rule-based strategies, enforce risks, and deploy capital systematically instead of relying again and again on emotional buy clicks. I know most of you are technical people, but there are traders out there, traders and investors, which actually invest in your ideas, and actually they will fund your tech development. I will have Mr. Dennis Egin representing George Finance. Dennis Egin is a multi-time founder, 3 times. He actually also had an exit. A product marketer with 20 years of experience across tech and Web3. He has led product, positioning, and go-to-market for many crypto projects. His LinkedIn is impressive, and I think you will understand a lot more on how you can take advantage from his products. Come here, Dennis.
Check, check, check. Thank you, Alex, for the intro. Let me check. Okay. So for the last several years, I think there was something strange happening in crypto. We built these advanced financial rails, and a regular trader, retail trader, would still behave like an addicted gambler at 2 a.m. in the morning. You know, having those Telegram signal groups open, tabs all over the place, maybe screenshots, making mindless, you know, exits from the positions and emotional moves. And most of them actually do know what they should be doing. But somehow, intention rarely survives execution. And this is exactly the gap I want to talk about today. So in crypto, we do have abstraction layers, new abstraction layers all the time. AI helps us to make decisions, and tokenization, you know, changes what can be owned, and of course, blockchain itself changes how the value is stored. But I think the next abstraction layer is something totally different, and I think it's programmable capital systems, meaning the systems that can control the behavior of the capital itself by enforcing the logic rather than human discipline. So it could be one of the defining moments for the next generation of DeFi, actually. Yeah, that's what Alex was mentioning. So retail traders actually oftentimes have pretty good ideas. They have conviction, and so they could be directionally correct in terms of, you know, where market is going. They could know their risk tolerance. You know, they could have their they would know that they need to stop losses and, you know, do right things, but somehow they still fail. Why do they fail? Not because the thesis was wrong, right? But because execution collapses over emotions, basically. So they start changing, you know, the sizing. They chase some crazy meme coin. So basically, the edge, the trading edge, is lost not in the initial analysis, but rather in execution itself. Right, so here I want to get a little bit more provocative and say that what we often call investing could be just a set of manual actions pretending to be a strategy. So what I mean is a strategy, the system for strategy could be those, you know, levels you get in the screenshots rather than the actual system, and the entry conditions that you find there could be the parameters for the system, right? And the risk tolerance, once again, could be not what people remember to do, but, you know, the enforcements that could put into those systems. So, like, let's be honest. Currently, the most popular system is human discipline. And this is insane because we built so much. We have, you know, on-chain settlements. We have like cross-chain swaps, zero knowledge proofs, and everything else. But we still rely on basically future ourselves behaving rationally, and this is crazy and outrageous. So there is this gap, or not gap, but more like mismatch. And mismatch is that most protocols think in terms of transactions, and people think in terms of the goals, totally different things. Nobody wakes up in the morning saying, "Oh my God, I need to, you know, swap this crypto from asset A to network B, whatever." Nobody thinks, "Oh, you know, better routing would be something I'm dreaming of." No, people think about things like, "I'm bullish on Ethereum. But I don't trust myself for the entry timing, and I want to buy dips, right? Or you could say, you know, I want passive income without much interference with the strategy to keep it running in the background. Or you can say, if you know, you could really want something like, when market changes, I want to be protected, right? So all of these things, again, not transactions, they're capital behavior, right? So what we want to solve is not like routing like in swaps, but we want to actually produce capital behavior policy. And yeah, I call it an intent gap, if I may. It's basically the space between what users actually want and how capital behaves. And in between, in this space, we have crazy things like, you know, manual decisions, changing context, and emotional behavior, and you know, all kinds of other things that introduce failure modes, basically. And yeah, when let's go back to the basics, and that's where it becomes interesting when people mention intents. The actual definition of the term is totally different depending on the who's talking about it. And protocols like ETHCluj and ANOMA, they have this basic architecture where intent is a state B, where you want to be from state A, and the whole job is, you know, to resolve it. So we are building something very different, and because this approach, more like technical approach, is only working for single step operations, right? If you really want to sleep at night and have your capital do what you actually wanted it to do in the first place with your intent, with your vision, then this construct of resolving transactions is not really working. You need something else. You need a different capital behavior system. Right, so let's switch from transactional thinking to policy thinking. So financial intents, as when we discuss over a beer with friends about crypto, is something fundamentally different, and people actually need policy as a solution rather than, you know, solver's market, which is also great but serves a different purpose. And policy thinking is something like, you know, grow my 100K to 1 mil with bounded drawdowns, and there will be example of this, even though it's a funny one. Right, so that policy, how could it look like? And we're trying to coin a new term, which is called fintents. And I think it's deserved to be considered this way, because we found this common denominator of pretty much any financial capital behavior you can find out there. And not only crypto, by the way, it could encompass other financial instruments and stock. And by processing thousands of typical scenarios and needs from the real world, we came down to a elegant and beautiful schema that incorporates all the basic elements of this policy behavior. That consists of course, desired outcomes as a sort of description where we want to be, but also everything else that make it deterministic. And I'll stop here for a second. Just think of anything that you dream of can actually be deterministically executed. And of course, executable because it's deterministic with our execution engine. So it has everything that you need for a good strategy: constraints, execution logic, rules here, failure modes, and of course attribution to actually evolve your strategy and improve it over time. You don't see this like fine fonts on the right, but this is an example of how a strategy looks like after a conversation with LLM that guides you first with root cause analysis and onwards to defining all those elements that you might not even think of. Like retail people don't know that they need a risk envelope, and it can suggest and then actually define those parameters together and save them on that FinTent policy document that is executable. Right, so briefly how this looks from the architecture standpoints. We have 3 phases: intent clarification, canonical orchestration, execution environments, which basically means that on phase 1, you're talking to an LLM that knows, it's not just conversation, right? It's not about being nice or knowing trade or quant trading or anything like this. It is actually guiding you towards creating that policy that we need on the second stage. So the output is a set of the primitives from the schema. Yeah, here's a good example. I want passive income without much risk, and then through the conversation, it discovers that what assets, what universe, what environments it will operate in, and define it. And the result is this canonical policy that covers everything needed for the execution, and the execution environments, which is basically a way of put to work, that final idea of making your capital work the way you want while you sleep. So it is working while you sleep. Yeah, and so, I mean, this is a ridiculous example. Make me $1 million, and if you were to tell this to a friend, they would probably laugh. Or if you put it into, pretty much, if you put it into your, favorite chat LLM, it will just discuss like what it is. Whereas our system can actually ask you things like, okay, well, how much money you have in the beginning? If you have $1, that's kind of difficult. But if you have like 100K, right? Oh, okay. So what's the time horizon? 5 years. Okay, then it gradually, what's your risk appetite? And finally, it can give you options and produce a blueprint for actually turning this 100K into 1 mil within realistic time frame. So just like with any strategy, it would condense, distill it to the elements that are executable, and you can even enforce like some risk components to it. So yeah, even though this is a funny example, it still is fully workable example that we'll be able to process. So if we compare to the tools that retail traders currently have in the market, many of them actually address parts of the flow pretty efficiently. So robo-advisors could tell you like how to balance your portfolio. Copy trading could give you sneak peek into edge. Maybe you can steal some ideas. Bots would be super disciplined, right? That have no emotions and DCA into your preferred asset. Signal providers might know, 1% of them, what they're doing and actually give you a certain edge based on the research. But all in all, this is all pretty scattered and fragmented, and there's no end-to-end system that can actually convert your intent into something that you can run yourself. You need to jump between those systems to make it work.
That's great. Any question from the audience? Huh?
Do you have intents yourself? Maybe you can speak up and say, I want this. I'm curious.
You mentioned that this is still in building. When can we try it?
Well, the prototype is there, where it trades in on getting it all the way to the policy. It does create a policy. It's not very it needs to be polished to be very sophisticated. And we're also onboarding 3 venues: 1 DEX, 1 perp, and 1 centralized exchange. So that the cycle is complete end to end. I don't have an exact ETA, but I'll make sure to let you know if you leave me your contact details.
Will do.
Thank you. Here's the gentleman on the left, in the back.
Gentleman in the back, here we go.
Do you have any on-chain enforcement layer or verifiability for the intents?
Yeah, well, as you can see, the technology is mostly off-chain, especially the initial AI part. But then it's an execution that will plug via these adapters on-chain venues to actually, place trades and get data from it as well. So it is like closely integrated to on-chain world as a financial vehicle, but it's not necessarily a protocol that has its on-chain part.
Are you targeting retail or also kind of institutions such as treasury teams or back office teams?
Yeah, the current hypothesis is that, of course, retail traders that don't have clear idea of the edge will be able to help them by LLM knowing the trades and navigating them to, like I was mentioning, instead of buy button, right? They could DCA into assets, and this is like super basic, but not even many people might know about this method and why it's better. But of course, with more connections, more venues, it will be suitable definitely for advanced traders, but we're going more like bottom up than the other way around.
Okay, thanks.
Thank you.
We have another questions all the way here. Here we go.
Okay, so my question is, will the user intent be public? Will you put it on chain or it will be private?
I think private by default, because most of the people would treat finance as something of their private matters. And again, it goes back to understanding intent as not an on-chain transaction that you need to route or solve, but rather your almost personal project that Gorge can help with end-to-end, by distilling that intent and put it to work. So the short answer is, I guess, private by default.
Yeah, thank you.
Any other questions? Here we go. Dennis, you're killing it.
Thank you. Hi, my name is Alex. One question. So basically, this product is like a trading companion. It's an AI that helps only with the mental strategy, or also gives you a real strategy where to buy all the things and helps you actually trade.
I'm sorry, I'm not sure I've heard most of your question. Maybe Alex, you can quickly repeat, sorry.
So basically, what I'm saying is, if this product actually helps the trader trading, so also helping with the mental part, but with how to trade,
Yeah.
etc.
Yeah, thank you. I got it now. So yes, it's meant to work both ways. Basically, there are two phases: intent compiler and execution engine, and policy in between. So yes, it is meant to take it end-to-end from like bizarre idea to actually trading autonomously in the background.
Okay, thank you very much. And also, if this product is for the retail trader, how much will be the pricing for?
Yeah, that's a good question. Like revenue streams and pricing model and all of this is still to be polished. I don't have like exact. We do have quite a good idea of monetizing the whole thing, but there's no decision on this just yet. We're aiming to deliver the value as the first step. I'll be honest with you.
Okay, thank you very much.
Now, Dennis, since this is the business stage, maybe we can do some business here. How about giving the people that attended here maybe a 1 or 2 month trial to your retail product? Tough negotiation going on.
Yeah, I'll talk to my co-founder, and I'm sure we'll be happy to do this, but we need to route it somehow.
So
as
do we have a deal or
We
not?
need
Do
to
we have a deal or
resolve your
not? Let's
intent.
make a deal here at the business stage. There we go.
Yeah, there we go.
Yeah.
Thanks.
Great product. I think I'm also from the trading space. And to be honest with you, sometimes I'm scared because, exchanges or any other brokers can have they can be messed up by these products. So I think, a new generation, a new, let's say, step, or new doors have been opened now with the AI, and exchanges should be very scared about this.
Absolutely. I can't wait to see you as a user as well.
Yeah,
Thank you so
I'm
much,
looking
Alex.
forward. Thank you,
Thank
Dennis.
you.
Great
Cheers.
product. Thank you all. So now, give it for Dennis. Give it. Now, I have someone coming in. He's a friend of mine. He's a very nice guy. He came and he arrived 1 hour ago. 1 hour ago. He came from Istanbul, Turkey. Now, a little bit about his experience. He is a Web3 executive and blockchain strategist, 11 plus years of experience in ecosystem growth, partnerships, and digital asset adoption. Delivered 300 plus talks and trained 10,000 professionals worldwide. He is one of the few, because I'm helping a local university in Bucharest, in Romanian American University. I'm helping the students understand more, but he's also a blockchain academician and advisor. So today he will talk, or maybe this talk that we will have, examines the emerging of DeFi paradigm and how intelligent infrastructure reshapes decentralized finance. He will show us how exploring AI-driven decisions can transform DeFi liquidity. All the way from Turkey, Istanbul, we have our dearest friend, Mete Ali Bashkaya.
Hello, everyone. My name is Mete Ali Bashkaya. I came from Istanbul, Turkey 1 hour ago. I'm also living in Romania. I'm living in Sibiu, 2 hours away from here, like Istanbul. Istanbul is 2 hours away from here, and also Sibiu is 2 hours from here. And actually, when I met with ETHCluj crew, I'm working for a company who is making some AI and DeFi thing. And after that, I quit the company. But actually, what I know is I'm lecturing at the university in Istanbul, also in lots of international universities. I keep the subject on myself because, you know, AI and DeFi liquidity providing is really getting huge and huge. And also Ethereum did a really big investment on AI, also keeping the AI and DeFi both together, so that I keep my subject, and I would like to tell you about Ethereum and also the AI liquidity. Actually, what I would like to tell is it's about 12 years that I'm into blockchain and cryptocurrency. I give more than 300 seminars all around the world and also reach more than 20K people. It's a really big pleasure to me, and also I have chance to give a speech in Davos and World Economic Forum as a only Turk in there. Actually, it was very fun. Actually, before Trump, it's a little bit boring, but after Trump, it's getting really, really funny. And I've been nominated lots of prizes and gifts, by the way. I have been selected in 75 the most effective person in crypto field, also in the blockchain field, and also in Turkey. And actually, what I am doing is I'm working with big institutions, giving advisory, and also doing lots of jobs with them. And anyone knows Star Wars? Did you watch Star Wars? Okay, I will let you watch 2 minutes video about DeFi and AI from the Star Wars. Okay? you will all you see all the things that I will make a presentation like that, but it's all good. Actually, you know, it's about 6 months ago. I read the news, and also I did an interview of Vitalik Buterin about AI and also the Ethereum combination, also blockchain combination. And actually, you know, everyone thought that because using AI, also making the implementation of AI is easier than blockchain. Everyone accepts this because, you know, if you want to do something in blockchain, it's a little bit mixed. You have to do lots of things, by the way, to make something in blockchain. But to make it in AI is very, very cool. Or every influencers are all trending that you will add some skills to code and you will do lots of coding things and something like that. But actually, to use the power of AI and blockchain together is really getting stronger, by the way. You know, with the, well, I'm always naming Ethereum as blockchain 2.0. After Bitcoin has been invented, the Vitalik Buterin also invented the apps and also the smart contracts, and I always naming it as blockchain 2.0. And if you have a secure and settlement layer with the AI execution layer, it's a very powerful thing that I think any of the quantum computing can break this thing with the AI and also Ethereum. It's not a hype. It will be like a vibe. You know, it's not something that will pass 6 months later, because right now, when I talk with the people, when I talk with the people that say crypto, blockchain, and AI, they always say me that some kind of tokens that making some AI or blockchain thing. But I am all talking about the technology that we will use, because you know, the blockchain can be used in two ways. Blockchain as a database, service as a database, and also blockchain as a service. We can use, with AI, blockchain as a service and also blockchain as a database-wise. And also, and these are the numbers that Ethereum has very huge masters in DeFi field. You know, 70 billions of total work, it's about 60% of the DeFi. Nearly all of the DeFi is all made on Ethereum, by the way. Arbitrum base optimism is 60% of ETH network, and also, as you can see, in every year, Ethereum DeFi implementation is going to 22% of growth year, by the way. What's the main thing that layer 2s has been invented? Because the gas fee in Ethereum is really huge, really high, and there are some speed and also implementation problem. But with the layer 2s, you can see that the fees are going down and down. It's about 47x cheaper than Ethereum main usage. But after the new Glamsterdam update, it will be more and more lower than layer 2s. And actually, yes, I'm in 2 years ago, I'm supporting layer 2s, but right now, well, I'm all layer 1 Ethereum right now. Actually, not supporting so much, but actually this kind of hype will make Ethereum better and better. Every time Aptos, Sui, and also the other layers and the other chains is saying that we are better, smart contract exploit has been cancelled, so that it has been protected that more than $9 billion with the chains. It's also, AI implementation is also very important for it. And also, as you may see, TVL grow with the AI, with the blockchain implementation. It's also growing more than 100% with the security-wise. And that's the most important thing that we can have. You are making trades in DeFi. And also, I would like to ask a question. In 30 days' time, did you use any DeFi product? You use? And anyone more? Any DeFi product? You also, okay. In DeFi right now, in every DEXs, AI bots are using the trades and also making the market making. And you cannot reach their speed with your human thoughts, okay? You cannot reach any time. And you enter a buying scroll or NFT or something like that, like a Ruffle did, okay? And you cannot reach it. And because of this AI tool, you can do is 24 hours and 7 days. You know, there is a crash in silver. It's about 3 or 4 months ago. It's crash and silver and gold. And it's crash, and if people wants to hold their derivatives by selling Bitcoin and Ethereum. And also Bitcoin also crashed. And as it was 24 hours, 7 days, the market is always living Sunday, Monday, Saturday, no problem with it. And we know, as we know, we are using the blockchain, by the way. And in few years, it will take the market domination. Right now, the stablecoin market domination is like 300 billion US dollars right now. But with the TVL and the AI implementation, I'm absolutely sure that it will reach the stablecoin. Right now, Ethereum has not more than 180 billion US dollars right now, the domination. Not more than stablecoins, by the way. But with the AI implementation and DeFi implementation, it will go huger and huger in 2030s, by the way. The implementation of AI and also with Ethereum with new skills of Ethereum, by the way. Yesterday, I have a chance to talk about 6,551 about NFT implementation in Ethereum and also using it as an automation with the AI wise. Right now, it's all developing, and with the Glam Amsterdam, in the, it will be updated in a very soon time, and we can use the AI, also the blockchain is very, very quickly, as soon as possible. And we don't need to make any human trades, by the way. We will use AI as every institution, as every human being are using AI. Yes, there are lots of dark sides of DeFi AI, by the way. I'm absolutely sure it's not innocent. I'm sure, but what I know is Mica, Wara, Turkey, and SAC will have to accept these options because any of the institutions make hand-on trading. Right now, they are making their liquidity providing with AI. Yes, I can ask any one of you that, will you believe AI's trust for giving your money or making your wallet to open for the AI? I'm sure half of you will say no, but half of you, yes. Actually, I'm not the no way. I'm the dark side of this institution. But if there's everything has been done, I quit my trading when the BitMEX has launched derivatives. I'm not trading. I'm just a DBA, okay? $5 per day with Bitcoin and Ethereum, by the way. I'm not making trades, but actually what I know is the future will be the plus quantum computing, with the AI, also with the trading wise, because every time the assets has to be traded to get more leverage functions. And what's the thing that DeFi has been built? It's all for freedom, it's for people's richness, or to make people make hard times. Okay, your mother and father can use mobile banking applications very easily, am I right? But 5 years ago, they cannot use because there are now not so much front end and UI UX user-friendly, by the way. Right now, I'm absolutely sure you are all professionals and wants to use some DeFi products, but actually what I know is sometimes I cannot use this DeFi product because it's not user-friendly. But with the implementation more human-friendly, that will be, I'm absolutely sure that there will be lots of things with the DeFi. Yes, centralized exchange will be used by the people who doesn't want to connect wallet or something like that, but the future is always DeFi. DeFi 2.0 is coming with the new halving 2028. I'm absolutely sure about it. Yeah, and you know, every time people say that DeFi is always having its own responsibilities with the people. Because, you know, if you lost your seed phrase, you're gone. If you lost your the UI UX or the backend options, you have been lost. But actually what I know is, how do I build AI agents? Not just humans. That's the thing that if you use AI in every condition, like while you are sending your message to your girlfriend with AI, you have to. I think, you know, it's very obvious. As you know, I'm a lecturer at the university. I'm not making the written exams. I'm always make them people to make the projects. And I have this semester I have 28 students, and 26 students failed because of why? Because they made everything in AI, not with their brains, with their imagination. Yes, we have to use AI in every condition, every in technology, but actually, first thing first, I'm absolutely sure that we have to use our brain. And what I will say is, for the market-wise, I'm sure that we are all technology professionals, but we love to make money. But right now, the market condition is not well. It's all dark, I'm absolutely sure. But what I know is, it will have the sun very, very soon, by the way, and we will go to green fields, green candles, and I'm absolutely sure that we will reach in every condition, every way. And see you next time in anywhere in the world, and thank you very much. This is my QR barcode. You can scan, you can connect me from every social media, by the way. Thank you very much.
We have a question here.
Okay.
Yeah. Hi. I was wondering, there was recently a report about deep AI, and they were talking about the herd mentality, where the agents start running towards the bigger yields, and this would actually cause a very big wave of money being moved around, and this would definitely affect the entire DeFi landscape.
Mm-hmm.
So I was wondering, what would the solution be?
Actually, it's about 7 months ago. There's incident happens. Maybe you may know. All the AI market makers has been collapsed, and the market collapsed. You know, that's the thing. And this has to be developed with as a service-wise, okay? They are using the traditional GPUs, they are using traditional everything else. I have chance to work with Harvard University, okay? They are now building their own AI with the help of Storch, okay? This decentralized keeping solutions, okay? It's really expensive. It's really huge and expensive, more than diesel, okay? Right now, they are making development regarding this. I understand your concern well, but actually, the greediness of the people make this collapse.
Exactly, yeah.
Yes, absolutely. This is because of human. AI doesn't do it. It's because of the human.
Yeah. Okay, yeah, thank you.
Welcome. Any questions?
Any other questions? This is going to be very interesting.
Yes, hello, my name is Paul. It's very nice to meet you.
Pleased to meet you, Paul.
You said you were also in lecture at universities and so on, and you have been part of, at the World Economic Forum. So besides projects, besides, the global situation at the moment, blockchain, AI, and so on, I'm curious, in Turkey, which I really love, I've been a lot of times there, what is the academic perspective as well from a kind of acceptance of integration at maybe institutional administrative level within Turkey? If you have any kind of knowledge about existence of project as kind of governmental level, or I'm also coming from institutional level, so from Romania, so we are building upon technology, not brands, or so we are finding solutions. What is the stage, if you have any idea, in Turkey of development within institutional branches of government stuff or academia and maybe e-health or so on with blockchain technology and AI? Is it is there an interest, behind the scenes of the government, because they know they need to prepare for this kind of, the wave is here, they need to do that. There are too many people around that needs to be processed in different kind of, interacting with the administration and so on. We are finding this the same in Romania as well. We need speed and convenience for them. What is the situation in Turkey? Because, I'm really curious about it, and you being here representing this kind of perspectives, I'm very curious. Thank you.
The communication institution from the Turkish presidency has uploaded their documentation to Ethereum yesterday. Yeah, you can also take the tweets and you can check it. The blockchain implementation in Turkey for the developer-wise, for the non-tech-wise, is going very well. But we cannot get any support from the governments. Okay, there are some hackathons from the government-wise. I'm also the jury in there. But what people did is right now having no different and new ideas. They are all making the copycats. In China, in Hong Kong, in the United States, in Europe, in Turkey, it's all in the same situation. No different solutions for like a needle, okay? And you can solve the people's problem in a head of the needle, okay? This is the thing that you can use blockchain-wise. But people are trying to use blockchain in a very needn't way, okay? For example, in health, okay, you can use blockchain to keep everything else, but it's absolutely very heavy to make it. But with a one server, you can do it also. You can use a blockchain or one server to keep the health data. It's a little bit different, but the implementation, but the adoption for crypto-wise is 100%. But for the blockchain-wise, there are not so much people. People are now doing it with the vibe coding, right now doing something like that, but it's all in copycat. In every of the world, same. Not only Turkey, but Turkey market is about the fourth biggest market in the world right now.
So there is a lot of room for kind of discussions.
Yes.
Possible solutions like, using best practices. Sorry. Yeah. So using best practices from one country to another at that kind of level.
Regardless
how to
of
find
the country,
solutions.
we can talk it on the regardless of the country because
It's interesting.
Yesterday I was in Istanbul and I have a lecture with Binance regarding DeFi and also on-chain analysis. Today I am here talking about AI and DeFi. Tomorrow I will go to Turkey talking about RWA. 1 week later I will go to Porto and talk about AI and DeFi again. And I will go to Kyrgyzstan to give an academic lecture about RWAs, which BlackRock did and to implement it to Turkey. I'm only one person that I cannot everywhere, and I cannot afford this kind of thing. But what I am trying to do is tell people about what has to be done for the blockchain technology. Crypto, everyone knows crypto. Everyone knows Bitcoin and Ethereum, by the way. But no one. I'm sorry they don't know.
Yes, exactly. It's very important to follow the young ones here to know that some of the great ideas for future generation of projects is combining academia with business sector and with governmental improvement. Absolutely. So when you go there and you try to synthesize out of great articles, academic articles, which are great idea resources, but you have to understand those kind of things in order for it to transform actually in a product.
Absolutely.
So it's a long journey, but
Yeah.
it's an untapped, like a treasury mine or something. Thanks.
Last way to go. Thank you very much. Thank you very much for the questions.
Any other questions? I have a question.
Okay, Alex.
Can you teach me make a presentation just like yours? Because that was amazing.
Thank you very much. Thank you very much.
It's interactive, it's easy, it's simple. I can see the experience of you being a teacher
Thank you very much.
and us being your students.
You say me and I will make it for you, don't worry.
Okay. So I think that was one of the most incredible presentations I have seen in a crypto conference. Thank you very much, Mete.
Welcome.
I know you're tired, but you killed it.
Thank you very much.
Yeah.
No problem. Anytime.
Perfect. Thank you.
Thank you.
Now, we're going to take a break. We need to eat. I know I do. I know I'm a little bit chubby, but I still need to eat some stuff. However, after the lunch, we will come back here at 2:10, and we will have a very interesting panel, DeFi and institutional, with Mark Richardson from Bancor, Filippo Moraski from Volksfinance, and Owen Healy Blockchain Talent. So we're going to take a break and see you all at 2:10, or actually in 2 hours and 10 minutes. Thank you. Bye-bye. Testing, testing, testing. You good? Oh, and I think we can already start. We're going to start a very interesting panel here on the business stage. It's all about money. The greenies. Cum? Sigur, da, da, las pieces se introduc. Do you guys want a bottle of water? Do you want a bottle of water? Yeah? Let me give you.
Test.
And we're back now at the business stage. We talk about money and how to make money, but also interesting products as well as services that can help us in that specific journey. In my opinion, this is one of the most important panels here at ETHCluj, DeFi and institutional. I'm pretty sure all of you out there that are seeing this and on our live stream, you know, everyone is a degen here, I believe, from all of you three gentlemen. I know I was one until a few years ago, but I have with me Mark Richardson from Bancor. I have Filippo Moraski from Folks Finance, and I have Irish gentleman Owen Healy from Owen Healy Blockchain Talent. Now, I do have some questions here that we have prepared together with the ETHCluj team. However, gentlemen, it will be an open discussion, like it's a Friday afternoon, grabbing a beer, try to be as transparent as possible. We might engage with our wonderful audience in case they have some questions regarding a specific topic. But I think we should start by introducing yourselves. Let's keep it under 1 minute. Explain what are you about, who are you representing, what are you doing in this industry, and let's get it started. I'm gonna go first with Mark.
Sure, I'll keep it nice and short. My name is Mark Richardson. I was previously an organic chemist prior to the pandemic. Switched to blockchain in 2020. First as a community volunteer. Had my first contract in January of 2021 with Bancor, where I started as a researcher, then the head of research, then the product architect, and now the project lead.
Hello everyone, I'm Filippo Moraski, head of growth at Fox Finance. Fox Finance is a cross-chain lending protocol, and we are right now in the phase where we are onboarding institutions, so we'll see a transition from just being a DeFi protocol to more an infrastructure layer.
Hi, my name is Owen Healy, and run my own recruitment firm, and find talent for a range of different companies, from trading firms to DeFi projects, including folks. And yeah, no, pleasure to be here.
Thank you, Owen, for speaking in English. Because some people might not understand that accent, but thank you for, thank you for, keeping it clear. Now, so, gentlemen, we're in a market that might not be as exciting in retail as it was 2-3 years ago. However, how do you feel about the institutional capital coming over to crypto? You know, in the last couple of years, actually 2 years, we have seen a lot. But what's your opinion on this? There is a follow-up question. Has it grown in the last year? I mean, we know it's there, but has it grown in the last year, especially this year until now? Do you think there is still institutional interest coming on chain or not? And what about the future? So,
I can start. So honestly, I mean, you just notice by going around conferences, there are more people into it than normal degen in t-shirt. So this means that institutions are just getting started in looking at crypto and in deploying funds. So they are looking more in a safe way to how to deploy funds into protocols. So, and protocol, obviously, they need institutional funds. So protocols are building the infrastructure layer to accommodate and welcome institutions. So I will say that we are just starting. We are at day one.
I think it kind of depends on what you mean by institutional interest, because you might look at, for example, the growing number of, let's say, cryptocurrency treasury companies and point to that as growth, right? And certainly in terms of institutional demand to purchase those cryptocurrencies, that is growth. But they're not really using blockchains in any sort of significant way. So I wouldn't say that that's necessarily growth for blockchains or DeFi, because it's much more sort of centralized finance leaning than anything else. But if you have a look at some of the DeFi primitives that are truly on-chain, or at least partially on-chain, that have attracted growth, you can point to things like MakerDAO, or now known as Sky, through their T-bill product. That has attracted some institutional interest. Whether or not you consider that to be true DeFi or not, I think is subject to debate. But at least it's using the blockchain in a verifiable way. And I think that we'll see more of that. I spend a lot of time in Switzerland and around the EU. And certainly the Swiss government and the private and public banks there are taking blockchain very seriously. But it's usually for that kind of DeFi use case, right? So tokenized commodities, tokenized stocks and other things, but then also looking to bring that kind of TradFi style product in sort of a blockchain wrapper. So yeah, the interest is there, it is improving, but it looks very different to the degen sort of economy that you were referring to from 3 years ago. So it's got a different style now, it's wearing different clothes, it's doing slightly different things, and it's, I would say, blockchain pragmatic, meaning like a minimal blockchain presence.
Yeah, so I guess Sergey from Chainlink used a very good quote last year, and he said, TradFi is DeFi's biggest customer, and in the last year we've seen a noticeable shift in projects completely shifting their positioning away from retail and towards institutions and what their demands are. And I think the institutional interest is definitely real. You see companies like JP Morgan and many other institutions significantly ramping up their blockchain teams. And yeah, those that aren't actively participating are curious and observing. And even, I suppose, what's refreshing at this event compared to some of the other events that I've been to recently, yeah, it's a lot more institutional presence, a lot more suits, and yeah, looking to see how TradFi products can be utilized in a more DeFi context. So,
I'm going to make a conclusion now. A lot more suits and growing new ways that we might not even know about. These are the two things and also for you, Filippo, you said pretty cool stuff. So it is going to grow in the future, but the suits might take over. We don't know. Or it will go in a different way that we actually don't know about. Cool. Any questions from the audience on this topic? No, not yet? Okay. Now, there's a tricky question here. Do current DeFi system actually work for institutional capital? I mean, are these let's say, decentralized finance protocols focusing now more on institutional capital management, or they are still mostly focused on retailers?
It's a nice question, but I will say that in the recent years, especially in the last year, we saw protocol building infrastructure, to accommodate institution. Like, for example, we transition from a peer-to-pool. I'm talking about lending protocol from a peer-to-pool system like Aave to a vault-based system like Morpho that is entirely built for accommodate institution, because institutions don't want, for example, governance that can change parameters, don't want other external factors that influence their activities. So they don't want to be. They want an isolated environment for the operation. So we are seeing, this transition from having a community-based model to a more isolated and private environment, where institution can move funds or deploy funds in a safe space. So yes, I would say that we are already in this transition from community-based operation to a more close one.
I think it's important to remember that the origins of DeFi are still deeply embedded in the sort of anarcho-libertarian, view of what emerging DeFi protocols would look like. Meaning that it was not just, let's say, not observing like TradFi institutional laws and what they're beholden to, but I would say more specifically rejecting it, like actively rejecting it, almost as a kind of protest, right? And so this idea of being like completely anonymous, peer-to-peer, and this kind of thing, this was the DeFi beginnings, and it was by design incompatible with institutional capital. And I think over time, it's interesting to see the kind of corporatization, right, of DeFi protocols. The one that I usually hold up as being the exemplar for this is MakerDAO, right, which started with, a fully decentralized, stablecoin invention, which I thought was absolutely phenomenal. But today, it's fully collateralized by USDC and USDT, right, which are, corporate stablecoin alternatives. But it's important to point out as well that, even protocols like ETHLend, which became Aave, also had a specific splintering of their DeFi offering from their more TradFi offering. They had something called Aave Arc, which was specifically for institutional clients, which allowed them to observe things like AML, KYC and ATF compliance laws and things. So I do think that as the industry turns to institutional clients as a way to drive revenue, and if that's the adoption pattern that they're looking to implement, it is culturally distinct, right, from where DeFi began. And so in that sense, no, I don't think that DeFi protocols were built to house institutional use cases, and it's requiring it's requiring a re-engineering, I think, to pivot towards those use cases. Whether or not we're selling our soul in the process, I think, is something to talk about. But no, these things are strictly incompatible, and they were designed to be strictly incompatible.
Yeah, so that's Great point. And that is the question the topic is about. Are we selling our soul in many respects? And yeah, I guess that's part of this thing that many have coined as the maturation phase at the moment. And a lot of people that would have organically risen with the industry now in many respects don't identify with it or feel that it's fluctuated away from its initial values. And yes, it's very noticeable across many different ecosystems that they've definitely moved away from that community approach and have made trade-offs to accommodate institutions. It's very protocol dependent. Some are remaining true to the initial values, others have shifted, and a case by case basis. But this maturation phase that many are talking about, has led to a lot of people not identifying with the industry that they once were intrinsically motivated with, that they thought was going to change the world, and now they're thinking, are we just upgrading the system, or are we re-architecting it? And that's kind of where we're at the moment. And
if I can add, I really have an open question. Like I always think about it, and because we are in a phase where we are maturating, we want to onboard institution, but I don't want that this demotivate people to build disruptive features. Like in the past, we all started like a degen guy that tried to explore, innovate. We also strange economics. So I don't want that in order to offer like a safe environment for institution, whatever, we reduce the amount we put in the creation of something interesting and exciting for the market. So this is my point.
I can see not that much of an excitement when we're talking about DeFi and institutionals, but I do have, I would say, an imagination, but not an imagination, a creation question. Just short answer. Are we adapting DeFi to institutions or institutions to DeFi?
It's certainly both, right? So, as I said before, institutions have a certain legal framework that they need to observe. If you're in Switzerland in particular, things like travel rule is like a super important and unavoidable consequence of whatever you're doing in DeFi. So both are compromising some of their, let's say, deeply entrenched habits. We've seen, DeFi protocols drift closer towards, what would be considered at least partially compliant infrastructure. And we've also seen both regulators and institutions also compromise a little on their side as well. I think the best cases that we can point to, let's say that the model case for what this kind of thing looks like is things like Melon, which transitioned to Enzyme many years ago, is kind of the original sort of on-chain capital fund, hedge fund style product. And I think it's in its 11th or 12th version now. I've honestly lost count of it. But they have always had the vision of serving specifically institutional clients. And you can see that in each iteration of the protocol, there are sort of new features, account keeping methods, even sort of exclusion rules that would make it easier for an institutional client to stomach and their regulator to stomach. And at the same time, you've also seen things like, over that story arc, things like the MiCA compliance, framework come out, and I know that that's still controversial, not universally loved by anyone on either side, but still an attempt to sort of make clear, what is considered above board and what isn't. And then in Switzerland, you see it's getting like very, very easy, right? The FINMA regulator there really has made pretty clear exactly what can be tokenized, what can't be, what is considered a token issuer, and so on, but otherwise fits into the existing security infrastructure that they already have. So yeah, it's a two-way. These things move towards each other.
Yes, I think that it's both. So I will say that there are protocols that are building proper features for institution, while there are other protocols that are trying to adapt in order to attract the institution funds, because at some point, if you don't adapt, there will be others that will do it. And it will be basically, I will say, BD works in order to attract this kind of liquidity. So yeah, it's both way of interaction.
Again, both, I would say. I guess I obviously deal in people, and I guess on a human layer, you kind of see your degens, your institutional crypto people, and effectively there's kind of three categories at the moment. You have hoodies, suits, and hoodies morphing into suits, if that makes sense. And I guess there's a disconnect still between both parties, but I do believe that there's a greater institution or a greater appreciation of what institutions bring, especially even from, and I know recent events might say otherwise, but from a security perspective, I guess institutions move slow, processes are very deliberate and slow for the right reasons, whereas obviously we've grown up in an industry where it was ship, and often at a compromise to security, and that's no fault of DeFi projects themselves, due to audits being historically just so expensive. They had to pick what was audited and what they could spend. So I guess as the industry is maturing and growing up, we're kind of seeing more hoodies morph into suits. So what we need is probably a greater appreciation for both sides and what both sides can offer. And yeah.
Personally, I think I'll put it 60% towards DeFi and 40% towards institutions. I'm a numbers guy. But both of them have to, give or take stuff. Mark, at one point you said MiCA compliant. And this is an open question, of course, to the audience too. If you have anything, raise your hand and I'll try to push your question. What does a compliant DeFi actually looks like in practice?
No one knows, right? That's one of the problems with MiCA. So a panel I did recently, I was discussing with someone who leads one of the major petitions for MiCA that's looking at helping the European Union, I think, to understand where the ambiguity is in the policy that they've created, and help them achieve sort of better wording and structure and how this might be enforced. But for example, one of the things that MiCA compliance talks about is token issuance, and whether or not a token issuer can be identified and what responsibilities they have after they've issued a token. And one of the let's say case studies is protocols like Lido, right? One of these liquid staking assets sort of thing, where if you provide ETH to this smart contract, it then issues you the wrapped staked ETH or staked ETH tokens as a result. And so in MiCA, it's not entirely clear whether or not Lido is itself, like the entity, a token issuer, or because it was generated by a smart contract, if the smart contract is a token issuer. And they take a specifically, they have different language surrounding whether or not it's considered a decentralized or autonomous token issuance versus whether or not it was an institutional focus. And then also whether or not tokens are, if they inherit properties of other tokens. So for example, in the Lido staked ETH case, clearly it's representing the ETH that you gave to it in some way. And this is similar to some of the Ethereum protocols that build smart contracts to wrap Bitcoin on one blockchain and then bring it over to Ethereum. So things like ZBTC, for example, or WBTC, and so on. And in those cases, the way that the wrapper token is regulated is based on, like, it inherits the properties of the original token that it is wrapping, for example. Whereas if you remember how Lido originally introduced the wrapped staked ETH product, they said that no, STETH is not a token that you get by wrapping Ethereum. You buy STETH with ETH. This is an exchange of ETH for STETH, and after the ETH is given to us, it's our ETH now. It's not your ETH. And when you want the ETH back, you can sell your STETH back to us for ETH. But the change of ownership is explicit. These are the kinds of things that Mika is really struggling with, because I think that they are naively trying to apply the old paradigm in finance, where you have very clear lines in the sand as to where certain assets are held and by whom, because everything is custodial. Whereas in this case, where things are automatic, whether or not, because you deployed a smart contract that issues tokens, should you always be the issuer, or is it now like out in the wild and it becomes an autonomous process? So the unfortunate answer is, despite how much clarity has been brought to the industry over the last decade or so, it's still really not clear what it looks like to be compliant. There is no example we can point to anywhere that we say, look, this is a fully regulated, properly compliant DeFi product. They just don't exist. Because what it looks like to be compliant from a US perspective might be very different from a EU perspective and very different from a Swiss perspective. And so, yeah, there's, it's really, really difficult to know. But in general, I think if we had such an example, it would be fully KYC process, and with proper AML and ATF compliance measures over the top. And I think most of the DeFi community, certainly the blockchain community, would reject that, right, as being a necessity, because it's starting to look very much like, this isn't DeFi becoming compliant. This is DeFi just becoming CeFi, and the original components just don't matter anymore. So yeah, I know it's an unsatisfactory answer, but that is the wrestle that we're going to have with litigators and regulators probably for the next 100 years. Like I can't see any end in sight.
Yes, to what Mark said, we have been discussing a lot with institutions and for quite a while. We're for building the next version of our protocol, where we allow institutions, asset managers to build their own lending environment. And what they are requesting are basically access control module, where they can have they can just allow people based on KYC, KYB, KYT. So this is something that will happen, and all the institutions are requesting it for users to access their own lending environment.
Yeah, so to answer your question, I guess if Mark can't properly answer the question, I definitely can't. So I'll just leave it at that.
So basically, in conclusion, it will take a little bit more time and friction until everything settles down. Yeah, it is a complex question, but thank you for your answers. I want to involve the audience as well. Have any of you actually used on-chain yields? Raise your hand, please. 1, 2, 3. Oh, nice. How much was the API 2-3 years ago? Do you remember? 20, 30%, right? So what is happening now? And this is where you gentlemen shine. I remember it was 20% at one time for BNB. This was 4 years ago. But indeed, over time, this has compressed, reduced, and we know actually what happened. So what's the actual value proposition for institution allocating to DeFi today And is this compelling enough to justify the operational overhead? I spoke like a true corporate man. It is a very complex question, but in reality, the yields have reduced significantly. And is it worth it now?
I do think that the net yield is also based on if you are in a bullish or in a bearish market. So it also depends on the borrowing demand, which means that they generate native yields on depositors. But in general, what we are seeing nowadays is that, okay, there is a base layer of yield, and then people loop on it to increase their yield exposure. So the base layer is, obviously the base APY is lower, but then, people loop on it to increase their yield exposure. So if we compare with the past, there was, I will say, lower effort in looping and a native yield boost due to incentive bootstrapping or other incentives initiatives. But nowadays it's more like looping things. People are trying to looping stable coin to increase their yield exposure. So it's more looping compared to the past years.
So I think, a couple of things to say. So you mentioned that over time, on-chain yields are trending down. And I think that is because, at least in the first case, if you cast your mind back to things like DeFi Summer, things like liquidity mining rewards and airdrops and all of these things were sort of the primary reason for anyone to participate in any of these products and weren't really at all interested in what the product does or how to use it. And AMMs, I think, are like one of one of the candidate cases that I would look at that I'm the most critical of, because they did a very, very bad job of communicating to users exactly what a yield looks like in the system and what specific financial instrument you're buying when you provide liquidity to one of these things. And we invented a lot of marketing words like fees that don't actually mean anything in an AMM context. And the yields were always low and the risk was always high. But as long as you're getting 250% APY because someone's raining tokens down on your head, you don't really mind what's happening there. And this served a couple of different purposes, including institutional purposes. Because in this case, the institutions weren't the ones that were using those protocols and necessarily getting the rewards, although there were some degen institutions that were doing this. They were rather the sort of the VC institutions that were actually forcing these protocols to provide rewards so that they could, establish some sort of exit liquidity for the token round that they had participated in before the project even launched. So institutions were still available back then, and they were making enormous amounts of money, for DeFi. They just weren't using blockchains or the protocols that they were investing in. Rather, they were, let's say, annexing the protocols for exit liquidity when they were trying to exit from their token disbursements after they'd finished vesting. So now a lot of those programs are not as successful. Like if you try those strategies today, the market has wised up, I think, to what it means to be on the receiving end of that. And so even the average crypto degen doesn't really want to participate in those kinds of things anymore because their scars haven't completely healed from when they were abused the first time doing it. The second thing is that in the same vein as when I said that, I think fees is a marketing term that's made up to trick naive users into using protocols. Words like even looping, which one of my fellow panelists just mentioned, is just a DeFi word for leverage, right? And institutions know what leverage is, and they know what a risk-adjusted return is. And the leverage that we give people on DeFi has a minimal return and maximum risk. So most institutions don't like using these things, and if they're going to take leverage, they're going to do it with, a pen and paper contract from a lender that they trust to do things that they want to do. And even then, they prefer the risk-free interest rate as a minimum, which is something you usually don't get out of a DeFi product. So yeah, there is, the drop in APY is partially due to abuse, right, of crypto residents that over time have learned to reject these programs. And then, the types of APYs that institutions are now being offered that they no longer have access to those abuse mechanisms is now having to, get these protocols to stand on their own two legs and actually find out how productive these protocols really are. And what we've discovered is the lending protocols are doing just fine, right? There's always like apparently infinite demand to borrow and short tokens. The things that are struggling are things like exchange protocols, even some of the like perpetual swap protocols like Hyperliquid and that kind of thing have seen reasonably good institutional adoption. But again, it's on the funding side, right? It's they found a new way to abuse gamblers, right? And that's always very, very profitable. So it's interesting to see like exactly where the APYs are, because the APYs that you get shown on the front end of a protocol or something like that on the website is very, very different to the APY that you're getting as the institution that's funding that protocol. And I think the difference is explicit and important.
Yes, to add to what Mark said, yes, in the past, basically foundation were just throwing money as aggressive incentives campaigns to the market to attract the mercenary funds, but obviously this in a bear market is not sustainable at all. So yeah, all the DPY were really influenced by these aggressive mercenary campaigns, and now there are a huge amount of yield-bearing product compared to the past. So we are seeing a lot of yield-bearing stablecoin. Maybe in the past the only yield-bearing product were liquid staking. So and yes, nowadays basically every protocol Interact is yield-bearing. Also with Pendle, we have asset that generates yields. So yeah, right now we have product that generate yields by itself.
Yeah, so I'll just strip it back a little bit. And you mentioned earlier, like, is it worth the risk? And I think that's what a lot of users are asking themselves, that question at the moment. And yeah, I guess recent incidents have obviously, the Kelp hack, the Drift hack being the two most prominent, have made people ask themselves questions like, is DeFi worth the risk at the moment? And it seems that like even in ETHCC, the talk was a lot about RWAs as opposed to DeFi. And I guess, I think like DeFi, we need to just, I guess, confidence is just a huge thing, I suppose, especially on the institutional side and on the retail side as well. And again, just to give you some stats, like crypto, 50% of North Koreans' foreign currency income comes from crypto hacks, and it contributes 10% to their GDP. So we, at the end of the day, like we do need to like make DeFi more secure, whilst also obviously staying true to its initial vision, which obviously isn't easy. And I think the DeFi space, as it grows and matures as well, there'll be a lot more sophisticated insurance products as well. I do believe that's probably an untapped market as well, given that only around 1% of DeFi is actually insured at the moment. So, yeah.
Yeah, interesting approach, to be honest with you. I have another question, because this is the business main stage. This is going to be a commercial questions. Are you guys ready? Don't hate me. I'll buy you a beer afterwards, and hopefully you'll forgive me. But some of the participants here at ETHCluj, some of them are, geniuses, and some people just want to know a little bit more. And I'm going to ask you.
Happy to start. I don't think it makes it more legitimate, but I don't think it illegitimizes anything necessarily. Remember, BlackRock has, 10,000 fingers in 10,000 pies all over the place. I think that it makes sense that if crypto is or was interesting, and that there are things that you can do there, and especially from BlackRock's perspective, investment opportunities such as their ETF for Bitcoin, that they would at least try it, right? And that's not to say that everything BlackRock does is always a good idea, but they do have a pretty good win rate. And I think with something like the Bitcoin ETF, they did identify, I would say correctly, that there is an appetite from regular people who want to take exposure to Bitcoin but refuse to use whatever centralized exchange that might be offered to them, specifically because they know about FTX and they know about Mt. Gox and so on. And so to have someone who is, I don't want to say more legitimate, because I think that would be giving BlackRock a little bit too much rope, but let's say more on the hook, right? If something like Mt. Gox was to happen to BlackRock, you know that they've got $120 billion in assets that you can sue them for. And that gives a lot of people peace of mind. And similarly, BlackRock, knowing that they have that kind of liability, are more likely to be on their best behavior, simply because there are hundreds of thousands of lawyers all over the world who would be salivating at the concept of taking BlackRock to court. And so you do kind of get some level of, let's call it security, out of that mutual antagonism. And ironically, that is exactly the subject of the PhD thesis from which Bitcoin sprung forth. So there is at least some element here that mutual animosity does result in security over time. But this is one that's much more entrenched in traditional legal structures and that sort of thing. So I don't think that it's necessarily, at least philosophically, at ends with the Bitcoin thesis. But at the same time, I will point out that it does nothing for example, the Bitcoin blockchain, right? All of this ETF trading and things results in very minimal transactions actually on the Bitcoin blockchain itself, which means that miners are still largely dependent on the block reward rate in order to keep their mining services active. Whereas the off-chain products that are being built around it by BlackRock and others are being communicated exclusively through SQL databases and other things. So I don't think that Bitcoin necessarily benefits. I don't think that people who want a bright future for Bitcoin should look to what anything BlackRock has done and say this is the example of Bitcoin marching on. But if you're someone who is just interested in swapping Bitcoin and speculating on it and that kind of thing, it kind of is positive. So yeah, I think there's it's different categories of improvement, and yeah, I don't think it's any more or less legitimate because of it.
Yeah, honestly, I think the same. I think that the general audience shouldn't be influenced by external actors. Like, for example, okay, the technology works, but this shouldn't be something that can be exploited by even important actors. Like, I do just an example. Like, okay, Trump launched a meme coin, and we knew that feeling when all the builders knew that feeling when he launched the meme coin. Basically, he ruined the image of our ecosystem. So, but we are not that kind of stuff. We don't do that kind of stuff. The same it happens with the Argentinian government. So, if you bring and you build a useful product, then the space accept you, and then yeah, you can bring more legitimacy to the ecosystem. Or otherwise, no. I mean, people shouldn't be influenced by external factor, even if these actors are very important.
Yeah, I would just say it depends on the stakeholder, to be honest, and obviously a lot of the stakeholders here, I would say, would see it maybe as a negative, but yeah, we can see a lot of people can take a balanced view, so like both parties can learn from each other. And yeah, no, just Mark mentioned a very good point about Bitcoin. I'm just curious to know, like, with the Bitcoin ETF, like maybe a bit off topic, like, but would, like, from a security perspective with Bitcoin, like with all this paper Bitcoin, would you be worried about that? I'm just curious. Sorry.
So your question is, from a security perspective, am I worried? What am I specifically worried about?
So like all this paper Bitcoin being traded rather than actual Bitcoin.
Yeah, so certainly there's potential for abuse, right? So I remember when the Donald Trump administration first took office, the most recent time, one of the things that he wanted to start talking about was the gold audit at Fort Knox, particularly, but also just the gold reserves, worldwide. And the reason he brought it up is because it's actually well known that there is more gold ownership on paper than there exists gold anywhere. And the reason that's possible is because the paper accounts can be duplicated, and they don't have the same sort of cryptographic authenticity that a blockchain is programmed to have. Now Bitcoin has that, right? That authenticity check and the double spending check, but once it transfers onto paper and becomes tradable that way, you lose all of that. Now, that is a security risk for people that are trading the ETF, but it's not a security risk for people that have Bitcoin in their wallets.
We're running out of time, but I do have actually 2 more questions. I want to push you off the edge a little bit here. So, who actually wins when institutions come to DeFi? The protocols, the token holders, or just the institutions themselves?
It's a super important question. You can imagine that there are different different structures of engagement that are going to be pursued. And remember, we're still this is a very PvP sort of environment. And so the institutions, when they show up, they're bringing the big guns, right? And remember, they act like they're your friend, but they are an opponent, right? They're there to drag as much value out of the ecosystem as they can, either through rent extraction because they are looking to own the protocols and charge people to use them, or because they have an edge that you don't, right? So specifically, like I said, with things like Hyperliquid, certainly things like Polymarket, where a lot of the quantitative analysis talent in the world is now being recruited by Jane Street to pursue effectively arbitrage on things like Polymarket, but then also in things like just simple spot trading. And if someone has access to better infrastructure, then they're going to be able to to apply a specific knowledge that you don't have in order to extract more value from you. Right, and this is like naive people doing stuff for apparently no reason is institutional bread and butter. And so, yeah, they might. It's ironic that they get welcomed. It's like inviting a fox into the hen house kind of thing, and being glad for it, being a hen. But it doesn't necessarily have to be that way. Another thing that institutions bring is, I think, a sense of sobriety and things done right. So, we pointed out that during 2020, 2019, maybe even up to in the beginning of 2022, I remember there were protocols popping out like maybe 4 or 5 a week on Ethereum mainnet. And a lot of them were very bad protocols, either because they weren't audited properly or not even coded properly to begin with. Or deliberately malicious. So one of the things that I think institutional interest brings is, let's say, a higher bar to entry. And for some people, this flies in the thesis of the sort of anarcho-libertarian view of blockchains. But I actually do think that's kind of a necessary, let's say, quality assurance aspect to releasing a protocol. And I think institutions, if they will be bringing their own protocols, or if they're going to be acquiring certain teams to develop protocols for them, they're going to have a much more sort of zero tolerance for the kinds of reentrancy attack issues that were really common in 2020, or the kinds of really low IQ exploits that we've seen even this year about things like token permissions and other things. So that kind of stuff would never get past. I was going to say Microsoft, but I think the new Microsoft actually probably isn't the right opposite number to hold here. But certainly Google would never let that kind of thing pass, and Amazon would never let that kind of thing pass. So I think that, yeah, it elevates the standard that we might enjoy, and this is a good thing, because we've spoken a lot about institutional adoption up here on the stage today already, and one of the two things that's come up more than once is LSTs and lending protocols, and be reminded that we're still in the wake of one of the most devastating attacks that affected literally the interface of both of these things with each other. So I think that, yeah, the future in a DeFi controlled by institutions, I think would be better protocol stability and security, but at the sacrifice of more rent extracting and the fact that you're playing against an opponent who knows more than you do and has a much higher advantage than you. So it's give and take.
Yes, of course. I mean, the question is if DeFi wins. Protocol defined.
So who wins? The protocols, the token holders,
yes,
or
exactly.
just institutions themselves?
So I mean, the protocol has to be sustainable in the long term, so as to generate revenue. So if you are able to attract a big institution, of course the protocol will generate revenue. Especially in a lending protocol, if institution brings their liquidity, there will be people that will borrow that liquidity. For example, if they deposit stablecoin, for sure there will be people that will borrow that stablecoin. You can also enable under collateralized lending, private lending, and yes, as Mark said, there will be more restriction in the UX in terms of parameters on how you interact with the lending environment, but I think is also a good thing. We as lending protocol, but those other lending protocols are trying to build a safe environment without limiting too much the user experience on the lending management of the position, in order to ensure that people can have a safe experience. Because at the end, the unique role of lending protocol that could be managed by a governance or a team is just to ensure that people can have a safe and a nice experience without jeopardizing the protocol. So this is the most important thing, and if institution brings an additional layer of security and push protocol to adopt a new security measure, this is only something that protocol will benefit from it.
So yeah, the question who wins, and I might be naive, but I still think everyone can benefit, and it's in some respects it's great that institutions are raising the bar, but equally you have to acknowledge that we're at risk maybe of DeFi being just a mere sandbox for institutions, and that's where we're at, and the story is still being written who wins. But I think to build a more bottom-up approach within the industry as a whole, I think we need to have fair valuations so the token holder can win, because we've had this insane high FDV culture for the last number of years. Protocols with zero revenue and zero users launching at multi-billion valuations. That was just fucking crazy. And yeah, we just need more organic business models. So yeah.
I love you guys. You kept it real through the whole panel. Thank you for that. Thank you for being transparent. Thank you, Mark, for your knowledge. I think I learned a thing or two. Thank you, Filippo, for your, the fact that you are open to certain stuff. And of course, thank you all for speaking your mind, because I totally agree with you. Are there any questions from the audience at this point? You have a question? Okay.
Hey guys, so I'm Andrew from RAC, and my question for you would be 6-month bonds in the US are currently paying just below 4%, whereas AVE yields, for example, are paying like 3.3% or 3.5%. So I'm a big DeFi maxi, but I do kind of start asking myself, like, why DeFi? Like, why would it make more sense for my money to be parked on Curve, for example, where I'm being paid in a token? I mean, the rewards are CRV, right? So rewards are meant to be sold, so that's definitely something that's going down, while also having smaller yields on USDC. So, yeah.
Yeah, the answer is you should take your money off of Aave, right? But it's the same as anything else. Like, I think people conflate sort of DeFi maximalism as you have pointed out, and I feel this the same way. So I'm not criticizing you, but DeFi is just another set of markets, right? And so you should be comfortable arbitraging the interest rate between, for example, the 4-year bond on U.S. Treasuries, as you are, arbitraging maybe the yield that you're getting on Aave versus Morpher or Compound or wherever it is that you're deploying capital. Because the more people that are DeFi maximalist that continue to contribute their collateral to, for example, these lending protocols, the lower the yield will continue to go. The idea in a free market is that it will self-equilibrate, because if you're not getting the same yield as you are on the literal risk-free rate in US Treasuries, then you should withdraw your money and buy a Treasury instead. And that will adjust the return on Aave. So this is where things like the efficient market hypothesis start to fall over, because there is a cultural pseudo-religious, lack of pragmatism when it comes to which sources of yield people want exposure to. And that's nothing new, right? People have done this, like, I can point out that, the Swiss version of the T-bill constantly is at like fractions of a percent even now, and has the risk of turning negative frequently. And people will still prefer to buy, a 0.25% yield on CHF than go and get a 5% from the European bank, literally 90 minutes across the, across state borders. So yeah, it's that kind of, this is a cultural phenomenon, not a financial one. But if you are upset that you're not getting, that yield, you should just go and get that yield, right? And if everyone did that, in an ideal case, under simulation lab conditions, the interest rate would be the same everywhere all the time.
Yes, and just to add, yeah, as I mentioned before, that interest rate is also due to the recent event, that happened to Aave and whatever, and also because we are in a bear market, so the borrowing demand is not as when we are in a bull market. So as soon as we enter the bull market, you will see the PY is skyrocketing, because there will be demand for stablecoin, so this will attract new depositors. And yes, as I said before, there are products that generate yields natively. Maybe they add a bit more of risk, but this is also something that you need to evaluate based on your risk return environment. Evaluations have to perform. So.
We have another question here. Go ahead.
Hi, my name is Stanisław, and my question is, what is the DeFi endgame? So in other words, what's the dream that you are chasing?
As a builder or as a user? As a user, is my dream is that all the people can choose to get paid in crypto and deposit in lending protocol savings products entirely on chain, off ramp without having to pay fees, spending with direct payment even without passing to crypto card or whatever, just direct crypto to merchant, avoiding crazy fees by banks, Visa, MasterCard. So it's just a direct interaction between the DeFi users to the merchant, but as also savings option, you get your salary, you deposit it, it earns I don't know, 4%. There are a lot of people. I mean, in Italy there are more than 80% of the people just keep their funds on banks without even earning yield on it, which is crazy in my opinion. There is no education on it, but also maybe there is no an infrastructure that allow it. Right now in DeFi, yes, the onboarding and off-ramping, it's something that you can do, but there are still fees. So in an ideal world, it's something that will be without fees, and it will be straight away. Deposit, off-ramp, get paid, pay, without even interacting with centralized services. So this will be the ideal world.
Yeah, I guess maybe a little bit off topic, but my dream in the short to medium term is that as the industry grows and matures from a DeFi perspective, that everything isn't based in USD stablecoins, and that we can kind of think of other stablecoins, because I think 99% of stables are denominated in USD, and that presents geopolitical consequences. So hopefully Euro stables become more prominent in a DeFi context and other stables going forward. So yeah.
I don't really believe in an end game because it implies that there's an end of something, right? So end game is something that you have in, a strategy where you know that a game is going to conclude after 80 minutes or something like that. DeFi has no end game by definition. Well, I hope by definition, because it's an infinite game. I hope that as we continue, there are sort of better practices in protocol design and implementation and engineering. And I hope that people become, less tribal and less religious about things and more pragmatic in how they treat DeFi markets versus CeFi markets. I hope that the boundary between those two things becomes, let's say, well-defined, but also necessarily blurry. And I hope that people that come to DeFi start to shoulder responsibility for educating themselves on what it means to be a DeFi user. One of the characterizations that I have that I wish more people would consider is that in a CeFi context, someone else is responsible, right? That if you do something, it's now someone's taking custody, someone is agreeing to guard you and nanny you, right, through the decisions that you're making. Whereas in DeFi, it's like, no, I take responsibility, which means every DeFi protocol that I use, I've read their smart contracts, right? And I've read their technical docs, and I know how the blockchain works, and I know how the consensus mechanism works. And I understand what it means when Google says that they can break, a 256-bit elliptic encryption curve key on Bitcoin in 9 minutes, assuming that they've got 500,000 qubits. That as a DeFi user, I know what these things are, and I know what the risks are, and I take responsibility for someone not, taking responsibility for me. I think that, that's not really an end game, but I hope that at some stage we do have that kind of cultural acceptance in DeFi, that no one is responsible for anything that happens to you but you.
To add, the problem would be related to the custody of the funds when you interact with DeFi. I'm seeing a lot of people that don't do the right OPSEC for custody. And this is a problem that, in a theoretical endgame, this should be solved. So, this is an important aspect when you interact with DeFi and we talk about endgame. So, because as I mentioned, there are literally people that they don't know how to store the funds, to maintain in a safe environment. So this is important.
We have another question here. Let's do it fast.
Yeah, I'm not gonna take so much. It's just like a question. I think you are talking about institutional and all this kind of stuff, but every time it's just like USDT, just dollars. How do you think about like other currencies, like local currencies? Like I'm not from here. I'm from Colombia. We have like a local stable coin. And in Bancor, we had before like some liquidity pools, but I was just checking and it's 0 right now. So how we can make it this like, because also we host some hackathons in Colombia, and there are some institutionals like financial that wants to get into crypto, but they don't know nothing. They don't feel like confident. It's very, I mean, for me as a user, if I want to go to Bancor, it's too much. I mean, I can do it, but normal people cannot do it. So how we can take all these institutional markets, but thinking about not USDT, thinking more locally stable coins to be for the real people?
Yeah, it's a fantastic question. And so we do, like, we continue to work with the Celo blockchain and, you know, token issuers like Stabilo, right, which I think has had the Colombian peso, you know, deployed before and still has, and also things like Mento and Mintio that, you know, are trying to get, let's say, the whole forex market represented on the Celo blockchain, and then things like MiniPay on Celo are trying to take out a lot of the, let's say, UI UX overhead on behalf of users, which is the other complaint that you had. So certainly. These things have existed and do exist. The big problem is that once these things are developed and released, in general, no one uses them, right? So in some sense, and this is true of blockchain across the board, you usually have people begging, right, for a certain feature, or saying there really should be a protocol that does this and this and this and this. And when someone builds it, no one shows up to use it, right? So it's as much on the users, right, on the would-be users for refusing to use these things that are built for them as it is on, you know, if you want these things to thrive and survive, you actually need to, you know, to use it. And if no one uses it, they will die. So, and, you know, again, this is just a free market mechanic. If, you know, if it scales and lots of people want it, then it will be there. But if you specifically want it and there's only a handful of you, then these things will perish and they will disappear. It's that simple.
Yeah. Sorry. I'm gonna cut this short. You know, we started this panel, me buying you gentlemen a beer, but I think you will buy me a beer because we went a little bit overboard. Great knowledge, great experience. Thank you, Mark. Great, thank you, Filippo. Thank you, Owen. We're gonna take a 1 or 2 minute break and then we will have Katalin showing his incredible product. Cool, and now we're back. So let me tell you a funny story. Does anyone know what these are from my shoes? Huh? No one? What are they? Apes, there you go. And apes are what? NFTs, there you go. Cool. So we have Katalin, Yuan, Roman representing Boost Art. Katalin is the co-founder, MBD of Boost Art. Focus on NFTs, digital art, and how fractionalization is reshaping ownership and the alternative investment market. So he will talk about rethinking NFTs and how Boostart is the world's largest on-chain collectibles on Ethereum. something about static and underutilized. So Katalin, you have the lead. Thank you. I'm looking forward to seeing this.
Hello, guys. Thank you for having me. It's a pleasure to be here today. So let's just take it backwards to the Ethereum community and talk about some DJing stuff out there, I would say, and that would be NFTs, of course. I don't know what NFTs represent for some of you, but for me it represents open access, I would say, which makes it quite nice that I can be here talking about this subject today. So yeah, let's just dive right into it. I would say that during the couple last months, if not years, we built a lot of infrastructure, but not so much about meaning. So that's the tension I would like to talk about today. For that matter, I keep coming back to one important event that has happened, I would say, in the last couple of months. That being that CryptoPunks have entered the Museum of Modern Art collection in New York City, permanently, by the way, which is quite an interesting event, for that matter, because it places them alongside the Warhol collectibles out there. So for that matter, I would say that institutional legitimacy has been earned around such collectibles. But at the same time, we also experienced 95% of collections actually crashing, effectively having almost zero trading volume. So these two things are both true at the same time, and this is basically the problem I want to talk about today. But before I jump into what has been going wrong in this market, I would like to also look into what's the opportunity out there for this NFTs, as we call it, collectibles. Right now, the market cap of the NFTs sits around $2.7 billion, which is some serious numbers, right? Serious numbers out there. But when we put it in perspective, I think that's not much. If we, for example, look at the total addressable market, for that matter, I would say let's look at the global collectibles market. I would say that there is a lot of potential to tap into that number as well. Also, the liquid comparables in this case. The RSL, sports cards, trading cards, especially CS2 skins, it's a huge market. It's much bigger than the NFT collectibles, which has a lot of culture behind, I would say. I'm not sure if I'm to think about a few years in the future, if I should, if, for example, the CS2 skins are gonna be still holding this massive value, because yeah, it might be that a lot of the players will move to something else, whereas I would argue that NFTs on Ethereum will be forever for us, and it's a big culture behind these assets. So we had CryptoPunks and some other collectibles out there which arguably hold a lot of value, but most people never got the chance to actually get into those, and the ones who did mostly watch, I would say. So what has happened then? Well, they came up with a solution for allowing more people to get exposure to this kind of assets, right? And the idea behind it was pretty basic and pretty simple. For example, CryptoPunks are quite expensive for most of the retail investors or collectors out there, and the way to allow them to get exposure is to fractionalize this in ERC20s tokens. basically democratizing access and facilitating liquidity at the same time. So I would say the pioneer in this fractional market was Tessera, fractional.art, the previous name they had. They were actually paradigm backed, and they got an investment of $20 million to play around with this solution, which is quite an interesting thing that has happened. But unfortunately, the experiment and the product kind of failed along the way, also because of the market conditions at that time. So they are not operational since then. We also have a couple of other ones, like notably NFTX, which basically has a similar concept, but once again through ERC20, so fungible tokens. Once you fractionalize those items, you lose a lot of value because the values of non-fungibility are basically lost with this kind of transformation. And we have also floating protocol, AFP.io, I believe, which launched in 2023, around 2023, which basically promised people a similar thing, but they have functioned more as a DeFi kind of options game. It was quite difficult to get around their product, and it was not necessarily allowing people to collect these valuable items. They flattened the art, they lost the meaning of what it means to accept, to work with, as they call them, strategy tokens. I'm not sure if you're familiar with them, but essentially how it works is that they would auto-buy the cheapest CryptoPunk, for example, from the swap fees and release it at a 1.2x, and then burn the profits. The token surged from around 1 million to over $250 million, which, well, you could say it was a success, but well, they call them the flywheel, actually, the flywheel concept, but look what has happened to their tokens. They actually crashed quite hard, so I'm not sure if the flywheel still stands here. I would argue that they act more like a boomerang or something like that. So yeah, once again, I believe that they missed the point of what it means to fractionalize these collectibles. Financial incentives, once again, they are not equal to cultural incentives. So I would argue that no one that held Punkster token felt closer to the collection, let alone felt closer to feel closer to a specific item for this collection, from this collection. So let's look at what it means, or what it would mean to basically try to preserve the cultural aspect of these assets as much as possible. So during the last year or so, let's talk about Pudgy Penguins, because I believe this collection is quite a good example of what it means to preserve the culture. They went all around and they built a lot of things around their product in this case. So they partnered with Walmart. They sold a lot of toys. They had so much social media exposure at the same time, and they believe, guess what? They managed to surpass Bored Ape Yacht Club collection, which has been established as #2 collection for quite a while. And their user, of course, loved it. Well, this is actually a pretty good example of what it means to work on that IP loop for your NFT collection, of course. And as I mentioned as well, we have the CryptoPunks, which makes it a pretty good example, a pretty good case for looking what it means to work on the cultural aspect for these assets. So the CryptoPunks arc, as I call it, of course, what has happened, quite interesting, is that the Yuga Labs transferred the CryptoPunks IP for the Infinite Node Foundation, a non-profit digital art starship. These guys have been quite quite a long time in the game, and they know what they're doing. The strategy basically goes ahead for decades. So, yeah, well, that's simply put in words here is that they believe that there is this beyond just obscure NFT collection. This is art. This can be categorized as collectible, and it's here to stay. But of course, a lot of the people still cannot own this. This is the paradox. It's quite hard to fractionalize these things, and perhaps it's not even what we should do, because yeah, we will look at what's the opportunity out there besides the CryptoPunks or the most hyped or the most important collectibles out there in the NFT market. So as I told you, these two case examples kind of showed us what it's possible when we preserve the cultural aspect. And unfortunately, or fortunately, it's just that we cannot apply the same external forces and the same concepts to most of, or the rest of the collections out there. So the mid-tier holo, as I try to explain it here, is that meaningful mid-tier ownership is eroding for a lot of collections, which are still quite valuable even during the bear market. And we do not require institutions to require them, and we do not require a sophisticated DeFi or IEP loop, such as Pudgy Penguin's case, for them to become valuable in the eyes of especially of the Ethereum community, but also of externals out there. So the real question comes. I would say that the culture first concept has never been tested on grails out there, or one-of-one art NFTs, for that matter as well. So how do we give meaning and value to the mid-tier and collections out there without these external forces? I would like to introduce to you an interesting concept to think about. This would be the Lindy effect. So what does it mean? Contrary to us humans, the more something has been going around, the more it's likely that it's gonna stay there, it's gonna survive. So for that matter, we have seen that a lot of these collections have survived the bear market, and they still hold quite some value, even without many eyes looking at them at the moment. And the thing is that we have to expose those now and build a culture that preserves their unique characteristics. So what I would say, given with the Lindy effect in our minds, is that what we need next is a model that lets more people participate in these assets, whose value compounds with time as we go further. So also very important here, without stripping what makes them unique, so the non-fungible qualities and opportunities that they hold. And guess what has happened also during the last years or so with the platforms that basically are, you could argue, the gatekeepers for people. We had Blur, of course. They were just very specialized for traders, for bulk listing and that kind of stuff, engineered only around those matters, not really suitable for collectors. For them, culture was never the point, only trading volume. And OpenSea has also, a couple of months ago, has launched OpenSea 2. So they now support the 19-chain token trading with a lot of rewards, these kind of things. Recovering market share from Blur actually, but this trading volume doesn't come necessarily from NFT trading anymore. It comes from fungible tokens, all sorts of fungible tokens out there. So they kind of went away from allowing people to explore NFTs, collectibles out there, and they recognized that in order to survive and go reach their targets, they have to allow trading any other token for that matter on their platform. Of course, we also have the royalties dilemma in place, which kind of adds a bit more pressure to the whole aspect. I'm not going to go too deep into that for this talk. And another platform that I would like to mention in this case, and the last one that has been active, of course, is the Magic Eden. They actually recently announced that they don't even support Ethereum NFTs trading anymore. So they completely just left that side to others, and that being OpenSea in this case. So I hope that I created somewhat of a clear picture of what has happened with this market during the last years. And if we are to actually continue building around this asset class, what should we do? Should we optimize for trading or for collecting and cultural connection? I would argue that we should go fully into cultural connection, because that's what currently missing from these platforms. So the new direction, I would say, should basically take some things into account quite seriously. The real question from here is not if fractionalization versus whole ownership should be the focus for these assets. It's where the model preserves what makes these assets unique, so the non-fungibility aspects, qualities, and properties that they hold. So for whatever we build next, I have 3 non-negotiables. Sorry, I cannot really pronounce that the word. We have access. We have to preserve access. We have to preserve liquidity, of course, and the cultural provenance, the preservation of that, of course. Together, never as trade-offs, as we have seen, especially with the other platforms, especially the fractional platforms out there. They always compromise one or two in the benefit of the other. So yeah, I would say this is the sacrifice that never should have been made. So yeah, for that matter, I also looked at Courtyard, Proofpoint here. For example, yeah, they see blockchain as infrastructure for physical Pokemon cards. They are categorized as collectibles for quite a while, right? And they are quite hot right now, actually. They do a lot of trading volume. I'm not going to go into numbers here. But yeah, what they say is that they see Web3 as a tool and not as a destination, and I kind of like that because we should try to have a similar approach here. We should not look at the trading infrastructure or any technological capabilities out there as the last point about what we should do with these assets, but more like as a transition point, and allow people to basically be exposed to these assets without realizing the technological capabilities behind what it means to trade fractional NFTs. So yeah, as the last thing, I would say that we should build the missing layer. I think there is a missing layer, and on-chain collectibles are valuable, and even though they're lacking behind other collectibles in the market, they're gonna eventually catch up one way or the other. So ideally, we also we are placed quite early for that journey, and as we have seen, especially with the other fractional platforms, the tokens without culture fell. So fungible tokens out of the whole NFTs do not hold any kind of value, in my opinion. Financial engineering alone creates a lot of friction. So yeah, for that matter, fractionalization, strategy tokens, as we have seen, and ecosystem coins, they promised a lot of things to users out there, but they haven't solved at all any kind of stranded value, which is still being out there. So yeah, and unfortunately we have also the overall market focusing on financialization. OpenSea too, Blur not so active anymore. I would say the OpenSea holds the majority of the market activity at the moment. So yeah, they're completely going towards traders at the moment because, well, this is we're being through a NFT bear market, so they had to do their thing. No hard feelings out there, but I would have liked or loved to see them being more focused on what it means to actually talk about this collection from different perspectives, from the collector's point of view, from the artist's point of view, and from the retailer's point of view, to allow them to basically go in and explore this market, because I think it holds a lot of value. It's one of the most interesting cultures tied to the Ethereum ecosystem overall, at least in my opinion. And as we progress further, we will figure out that, yeah, they are quite iconic, these items, and they are here to stay. So for that matter, I'm actually building the next layer, allowing people to get exposure and learn more about what it means to interact with this. If they want to help and if they believe in the mission, they're more than welcome to come along and basically just take NFTs back to the house. Thank you so much for your attention.
Thank you, Katalin. Any questions from the audience so far? There we go. Katalin, stay back over there.
Sure.
Here we go.
So, great presentation. I was thinking, if NFTs are art, then if you fractionalize them, how does this improve their art's value? Like for somebody, isn't it important for them to, if they own something as a collectible, as an art, isn't it important for them to own all of it, or what's the argument towards that?
Yeah, so if I understand your question correctly, there is two perspectives here from the guy that just wants financial exposure to a particular asset or a collection out there. I would argue that buying their ecosystem, ecosystem token from a particular collection out there, it might be helpful enough for that particular objective, but not so much. And yeah, when we talk about fractional NFTs here, yeah, preserving the artwork, so the images for that matter, right? It's quite important, and that hasn't been done before by the other platforms. And we actually preserving that as much as possible at Boost.art. So the fractions themselves are NFTs themselves, so further NFTs, allowing to preserve the artwork in that case. And you can still trade them quite nicely on the market, on OpenSea, as NFTs, or any other platform that allows it. But for sure, we will not go to the same strategy where we have fractions being represented as fungible tokens without any kind of values out there. I think to kind of finish up answering your question, you have to think about, okay, if I own 10% of artwork, this is an artwork at the end of the day. A lot of people argue that maybe a CryptoPunk is not artwork, or a Bored Ape is not artwork because it looks ugly or whatever. That's not the case here. You would still want to preserve the visuals as much as possible. So yeah, we are taking that step towards basically allowing our fractions to be represented as much as an NFT with their particular valuable properties.
Okay, any other questions? Nothing so far. Thank you, Catalin. Great presentation.
Thank you.
I am a big fan of NFTs as well. Cool. Right. So we recently had a panel discussing about DeFi and institutional capital. However, what is going on with this DeFi? So I have Andre. Andre Duma. Andre is the head of DeFi at LeFi. Get it? DeFi at LeFi, a universal marketplace API. He leads the sales and the partnerships team, helping major wallets like MetaMask and Phantom enable seamless asset movement. So basically, deposits in DeFi have always been complex. I know exactly what that means. Multi-step process requires swaps, approvals, confirmations, bridges, and of course multiple protocol interactions, and of course often across chains. So LeFi is trying to fix that. Andre has something really interesting that he has prepared. Let's see what he's got.
Hello everyone, good afternoon. Just to introduce myself briefly, I'm the head of DeFi at LeFi, or LeFi. Technically it's LeFi, but it's just weird to say DeFi, LeFi, so I pronounce it as LeFi. Today we're going to talk about multi-step transactions in DeFi and how that is a huge pain and how we at LeFi were trying to solve this. This presentation actually has been built for a 30-minute slot, but I'll try to, wrap everything in the 20-minute allocated. So to kick things off, 4 years ago, we used to call deposits zaps. That's how everyone in DeFi understood deposits. A zap was basically a swap, bridge swap, and a deposit. However, nowadays, it's just purely deposits. That's how kind of the users in DeFi are understanding this. The problem is that liquidity is not only very fragmented in the DeFi landscape, it also comes down to the liquidity pools and the contract addresses and how you want to do the actions on chain. Because right now, and there's actually a zero here, if you want to do a deposit, you need to do, in some cases, a swap on the source chain. Then you need to bridge the funds. So that is basically one signature. Then you have to approve the token. Then you need to swap your asset on the destination chain, approve the vault, deposit, and then check on chain if it worked. So it's quite a pain. And for anyone who did a deposit into any vault, you probably know that you don't have the source asset, which might be, ETH or USDC, because, why would you hold ETH in DeFi nowadays? So we're trying to abstract everything into a one-click experience. And we know that user retention actually has a big drop-off because it's complicated and because you need to do so many actions. And it actually, like we timed it, it takes 15 to 20 minutes to do a cross-chain deposit into a vault. And we're just talking like purely vaults for earn. To go a bit back in the history, initially we just had the transfer assets, so Bitcoin, ETH, then we had the swaps, then we had the bridging, and nowadays anything can be combined into a deposit. The deposit basically started after DeFi summer in 2020 when people realized that we don't have yield on chain. So when yield came on chain, then we obviously had a new problem that we had to solve. And why was this never a primitive? Because yield wasn't designed to be on chain. Yield on DeFi, on Bitcoin, on Ethereum, on USDC. And the problem is right now that you have so many different types of contracts, so nothing is unified. Then you have the cross-chain overhead, whereas you have different types of bridges, different types of intent-based DEXs. and there's no shared execution layer. So basically, you cannot go from ETH to USDC on Aave, for example, as a destination chain to get your yield there. You have to do, as I said, +6 transactions. But we've worked on this, and we actually, as I said, we had Zaps, 3-4 years ago, but it was a very bad, sort of say, experience, even for the users back then, because Zaps 3 years ago were basically designed through certain bridges which had what we call destination calls. So a destination call basically allows you to do to call the contract after you bridged in the same transaction and do the deposit. The biggest problem was that there wasn't any simulations. You also had a lot of dust in the wallet that remained. So we've worked on this for 24 months, and we built something called Composer. So Composer basically allows you to abstract everything into a one-click experience, because you have an explicit step composition. So the developers declare what the actions are before they deposit. And then you have to also validate before signing. You have the dynamic call data injection. So basically, you take the output of any transaction and you can use it as an input to roll over into the next transaction. And I'll speak about it in a few seconds. That can be chained onto multiple transactions. So deposits is just the first step, but you can do so much more, because now you have a primitive that allows you to have a chain of events like swap, bridge, swap, deposit, and then take a loan and then put a limit order as a stop loss, for example, for your position. And I think it's very important to mention also that you have lower gas overhead, because you're batching multiple transactions into one. So you don't have to basically click 6 times or pay for the gas multiple times. As I said, I wanted to get here, so to the V1 that we're shipping right now, because in V0 it's any token on any chain to deposit. So any token on any chain to any action on any chain is what we just released right now at Li-Fi. It basically allows you to do any atomic flow, and in 80% of the cases, indeed, it's gonna be just deposits, just vault deposits. But vault deposits include looping sometimes, and doing looping in a vault necessitates a lot more than just a deposit, because you do the deposit and then you take a loan against your deposited sum, and then you loop that multiple times, so you basically increase the leverage. Now, if you're doing that, you obviously have to batch multiple transactions in the contract, and also in some cases you might want to have a stop loss, because you don't want to wait until your health ratio goes down. So in this case, we do the swap, we call the contract, we add the guardrails. The guardrails are basically what I just mentioned, which are what you want to do within the contract. Then you have the deposit into the vault, and then you have the deposit into the next vault, or the looping, and then you can have a stop limit order, and whatever you as a developer are inputting in the contract. And to showcase another example, we just talked to a big market maker in DeFi, and this is something that even market makers could use, because when they bridge funds on chain and they manage liquidity on chain, in many cases you'd be surprised how many manual interactions are happening. So this basically makes your life a lot easier as a developer, as a market maker, as if you want to have an earn front end and so on. So as I said, 6 steps, 2 signatures, way too many fields, way too many pain points. To actually get to the point of what I wanted to say here is, we productize this in a way so that neobanks nowadays can use Composer, because Composer is basically a tool just for developers. But as a just a normal DeFi user, you want to have access to a product, and maybe you're not that DeFi savvy. So that basically means DeFi Earn. What DeFi Earn is, it basically allows you to get yield on chain. It allows you to have the data part, because Composer is just the engine, which is the most important part. However, you also need the data part. And for the data part, I mean, you need to have the analytics, you need to have the historical APY, the projected APY. So if you combine those two together, you basically have DeFi Earn, which allows yield from anywhere on chain. You have the full execution flow handle, you have the Composer powered safety, and you can launch a yield product, not a stack. So you basically can choose whatever yield product you guys want, and we can just add it into Composer. And Composer is basically a TypeScript, so it's super easy to add new integrations with one click start to finish. So this basically is the productized version of Composer. So you click deposit, we simulate obviously the full path, then we have, as an example, ETH to Arbitrum, ETH to USDC, and then USDC enters the vault and allows users to get the yield on chain. And sometimes there's compounding of the yield on chain. So you can also do the compounding within the contract through Composer. Flows that used to take a quarter. Something very important that we realize is the dust sweep. So users have a lot of dust, a lot of unnecessary tokens, small amounts of tokens in their wallets. So as a neobank or as a wallet, because most wallets nowadays are becoming a neobank, you want to allow your users to have certain features which centralized exchanges have. You probably know that on Binance or on any of the big centralized exchanges, you have a dust sweep. So just sweep everything that you have as low amounts in your centralized exchange wallet. The problem is not really a pain point that has been solved in DeFi. So with Composer, you can basically dust sweep everything and get it into your dedicated token, like ETH, for example, or like USDC. On top of that, you can do a dust sweep and a deposit. Let's say that you have multiple tokens on multiple chains and you want to bridge swap them and then take them on a destination chain and deposit them into a new contract. What we're also working on, because we're very business driven, so when we hear feedback from our users and from our clients, that's what that's where we're heading, is the multi-vault deposits. So you can split a single deposit across multiple vaults. This is something that we actually think is going to be a new primitive in DeFi, because it allows people, if you have a source token on a source chain, but you want to split your tokens into different yield opportunities on different chains, you just think about it. You probably need 4 to 6 signatures and steps for one deposit. If you multiply that by 2 or 3, then it's gonna take you like a half-time day to actually do that. So you abstract that into everything, and also the portfolio rebalancing. The portfolio rebalancing allows Composer, you just give it the input, you're telling Composer what you want Composer to do, which is basically rebalance at every 6 hours based on the APY, if it falls under or if it's the targeted APY, and that it rebalances everything into the asset that you want. Everything that I spoke about is live in production already, is being used. So far, we processed about $20 to $30 million in TVL through Composer and through the Earn product. It's live on Jumper. Jumper, for the ones that don't know, is our B2C product. It's jumper.xyz. It allows you to do swapping, bridging, getting yield on chain. It's a super app. It's actually the most used cross-chain venue for aggregation right now in DeFi. I suggest you try it out. I suggest you go on jumper.xyz and actually try to do a swap, a bridge, and also for the earn part, you don't need to do the swap and the bridge beforehand because you can do it all into one transaction there. What you don't have to build anymore, you basically don't have to do the hooks for the custom bridge and the swap. You don't have to do the app-specific approval batching logic. You don't have to do the per chain, per protocol deposit user experience. You don't have the fragile multi-transaction state management. So all those here are, as for the ones of you that are developers, are huge pain points which took us 24 months to solve and to actually productize it and ship it for our users. So I think that with Composer and with the Li-Fi Earn product, you solve for so many issues. So Vault is just one of them, and that's why we have Li-Fi Earn. But if you want to build on top of Composer, that's super easy, and for any developer, they can do that right now, basically given what actions they want to do. So I think that you should remember this presentation as in you can now do any action on chain batched together into a one-click experience. Swaps, bridging, deposits, limit orders, anything can be batched into a one-click experience for your users and for the apps that you're building. Capital flowing from anywhere to anywhere is basically, as I said, you want to have a seamless experience for your users. Making capital move effortlessly is as important as building places, to put it. Basically, what I wanted to say through this is that you have capital in your wallet that's just sitting idle. And in many cases, you could just put it to work in a very effortlessly way. In my example, I've been a Power DeFi user for many, many years now. I didn't seek yield, mostly because I knew that, one, I have to search for it. There's a lot of work in searching the yield, and then there's also the execution part. So now basically, I just use Li-Fi Earn to put my tokens to work. I'll leave you with one question to think about. If you could ship one multi-step flow next month without building it in-house, what would it be? If you could do anything that requires multiple transactions, what would you ship in the next few months? It can be a swapping interface, it can be a bridging interface, it can be both, it can be a yield opportunity, it can be a limit order, it can be a perps venue, whatever would it be, think about it, and just remember that you have Composer as a tool for you as a developer and also Li-Fi Earn for you as an end user. That was it. Thank you so much. And I'll be around here, so if you want to talk about Li-Fi Earn and Composer, I'm more than happy to answer any questions. Thank you.
Any questions from the audience? Huh? Nothing? Here we go.
Thanks for the presentation. Can you hear me?
Yeah.
Okay. And that sequence is very dear to my heart because we're trying to build, something along those lines. But technically, for a non-programmer, how did it become feasible? Is it the consequence of the recent Ethereum account abstraction advancements, or like why it was not possible before?
I think there are multiple answers to why it wasn't possible before. It was possible, but it was a very bad experience. So after we had a few bridges like Stargate or Across, they allowed for destination calls. A destination call basically allows any user to do the bridging and the swapping, batch, and also the deposit. But the experience was very bad because you had a lot of dust. You didn't have any simulations for it, so users were basically getting left with a lot of failed transactions. And why it wasn't a big thing so far? I actually think that initially the yield opportunities in DeFi were bad or non-existent. So it takes time to build stuff. Like many years ago, everything was so fragmented from wallets to tokens to chains. So you were used to the idea that it has to be complicated. But now if we want to onboard, 1 billion people on chain, then obviously it's going to take a lot of more effort to make it as seamless as possible.
Hands? I think that's it. Thank you, Andre. Oh, here we go.
Thank you for the presentation. Currently, I know the composer is out there for quite some time. I actually hacked a bit on February in it. So far, what have you seen being the best case of the best use case of composer?
So far, and I think that 80% of the cases is going to be deposits and yield. So with Composer, you basically have deposits. So swap, bridge, swap, deposit, and getting yield on chain. But I don't want people to just know Composer and use Composer for deposits, because it's possible to do a lot more with it. So you can do the deposits, which is obviously, it solves a big pain point, but you can do looping within the deposit function that you've done, and like a limit order on top of that. So for now, I think that the biggest use case is obviously yield, so earn, and then you can do with that whatever else. So don't think that you have guardrails because it's just a swap and a deposit.
I think that's it. Thank you, Andre.
Thank you so much.
Thank you. Cool. Great stuff. Now, we're gonna switch into something that most of you don't like, but some of my friends actually got into trouble. So it's good to have a good lawyer, to have your back. And now we have Mihaela Rotun from Maxim and Associates. Mihaela is a lawyer specialized in contract, commercial law, GDPR, and recently she has been examining AI's impact on legal practice, liability, and data protection. Now you may ask yourselves why. Well, public blockchains promise transparency. This is what it was told to us. Yet sustainable adoption requires privacy. Now, balancing these two forces defines the next phase of Web3. And I hope we will understand a little bit more about these upcoming phases from Mihaela.
AI Act, which I don't know if you all know, but will be fully in force until the 2nd of August of this year. So what I can say about the intuition of European regulators is that they are trying to find more efficient ways to make the regulations, to put the regulations in place and find ways to keep up with the new technologies. So that's why I think it's relevant to talk about the architecture of the blockchain systems and whether they can be in alignment with the GDPR regulations. So the main topics that we will go through today will be blockchain transparency. And what I want to point out from the beginning is the fact that I would like to talk about this transparency from an architectural system kind of way. Because I believe most legal issues arise not from the misuse of transparency, but rather about how the transparency was built on the system. Later on, we will touch about the pseudonymity problem. And I think this is important because maybe a lot of you think pseudonymity is pretty similar to being anonymous. Well, I would like to actually have a few words about that and tell you that from a legal perspective, that's not always the case. Third, we would like to address whether on-chain data can be considered personal data and what are the implications of that under GDPR. Fourthly, we will see some GDPR's core principles and the person behind the transaction. But what I want to point out is that pseudonymity does not guarantee anonymity. And why is that? Because, as I mentioned before, a wallet address may not directly name some personal information, but it can name some aspects that can lead towards the person behind the transaction. And I will give a few examples by that. From a wallet addresses, you can actually has a certain number or is of a certain impact. And we are from a small town where we know that only certain firms or certain individuals can be behind such big transactions. If you correlate that information with something you can already find on public institutions' informations, you can actually have an idea of what type of person was behind that transaction. So the next question will be, does the data directly name the person? As I said, no, but it indicates some aspect that can lead to the person. So moving on, can be that data linked to an individual? And I believe it is, and I know a lot of that can lead us to the person behind the wallet, then GDPR applies. So what's the main problem here if GDPR applies to a blockchain system for the purpose to be concluded? When it comes to blockchain, that data is recorded in full, which means we have no limitation of it. Moving on, we have the purpose limitation, which I said, we have a certain purpose, we cannot go beyond it when it comes to personal data. However, if we see a blockchain system where everybody basically has access to it, everybody can also have different purposes for looking through it, for collecting it, which means that the purpose limitation is also not being met in the system. Also, we have storage limitation, which means the data that is collected does not stay there forever. It needs to stay only for a limited amount of time. What happens in the blockchain system now is that it be implemented and are being implemented today in order to be in accordance with the GDPR regulations. And what that can be is concluding the data process assessment before deployment. Which can pretty much makes us know the risks from the beginning of linking the informations that we obtain from blockchains to a certain person behind the wallet address. Also, what can also be done will be to store personal data off-chain, to only put the informations on-chain that can hardly be traceable back to the person behind the transaction. What else can be done will be to identify the relationship between controllers, processor, and controller joints. Basically, what I'm trying to say, to build that relationships, to know who acts as a controller, who acts as a processor, because accountability will most of the times be used by the data subjects, and we need to know who is responsible for that in order to truly know where to go for our legal claims. Also, we should establish basically a lawful basis of how we collect the information that we get on the chain. And last but not least, to review our privacy notices. As we may know, when it comes to data privacy, a lot of the times when there are risks of leaking the data or when the data goes off the purpose limitations, there are some notices that are being sent to the people that are being basically leaked, or their informations are being leaked. So that's why I believe these compliance responses can still be relevant what the interpretation of these lawful bases are and what risk we are heading on when it comes to using the blockchain systems. So I'm really looking forward to hear your point of view about this. And what do you think about GDPR and the transparency of blockchains? And even tell me if you've seen some compliance responses that were being made in the system that you have seen. Thank you.
Great. Any questions from the crowd? Don't worry, they'll come back to you as soon as they go to prison. Oh,
yes.
Someone just became wise. Let's go.
Yeah, I was reading, I think, recently that there is going to be quite a few changes to GDPR. Is there also maybe going to be any change in like this permanence requirement that they have?
Sorry, permanence requirement, can you be a bit more specific?
Yeah, so that like your data must be deletable basically, and like a blockchain wouldn't fit in that picture.
Yes, so I believe it's important to find like a middle mechanism for it, because the right to erase data is one of the most fundamental rights under the GDPR. So basically it's a pretty important right of a data subject to be able to tell the controller when the data wants to be basically deleted from a system. Of course, this response or this right can be made only in certain circumstances. For example, if the purpose was already met and basically you don't need to store the data anymore, it's only rightful for the person that his data was being basically operated to tell the controller to get the data off the system. So I believe there should be some mechanism that basically meet both of these aspects. So to also be able to let the data subjects do their rights as they are in the GDPR regulations, but also to not get so much of the system so that it's not what technological traits we would like to still have in it.
Okay, any other questions?
Yes?
Here we go.
First of all, thank you for the presentation. I've been thinking about GDPR and blockchain for a while already. This is just from a sort of negative side of things to look at it, is that what I see a bit of a danger, and I'd like your view on that, is that basically what you laid out is that if you look at it strictly, technically every blockchain company can be fined under GDPR. And what do you think that the threat is? And depending on where you stand on some of the regulation, what we see is that sometimes regulations are weaponized in the sense of we have something else that we want you to do. If you don't do that, we're going to use GDPR against you. And since what you've laid out is basically an impossibility if you're really like a blockchain native company, there's the chance that that GDPR is weaponized against legitimate sort of concerns. And yeah, you will be in violation regardless, if taken strictly. So the question is really, basically, what's your view on that? Do you see that potential as sort of a regulatory overreach with GDPR as a core element in it?
Yes, to be honest, I think it's pretty important when it comes to fines. Of course, they can be possible because of the structure itself, as I said. But what I think needs to be taken into account by the institutions that usually do those fines will be, what's the real risk of the information that we already see on the blockchain to actually be linked to some personal data of the person behind the wallet, for example. So I believe the fine should not be basically made only hypothetically to say, so, okay, data can be linked. No, I think when it comes to real fines, we should take a concrete case where something like that already happened. And why did it happen? I don't think most blockchain systems will be fined only, like I said, on an absolute terms of the GDPR and compliance. No, I believe once there will be certain cases where indeed such problems did exist, and the person behind it wants to get to the bottom of it to see where did it came from, where could it have been stopped.
Colombia. However, he will fill up for someone right now. He will talk about the EVVM, virtual state blockchains for Ethereum vertical scalability. We have Juan. And
Okay. Hello, everyone. My name is Juan. I'm gonna talk about Ethereum virtual blockchain machines, like a new idea. You can have virtual blockchains in Ethereum or in any layer 2. So, just for context, I work for Celo in the blockchains because they need to make like some upgrades to the core contracts of the blockchain, and if you want to avoid this, you can have like another option. So EVVM solves all these problems. With EVVM, you can have gasless UX, you can have account abstraction, you can have full composability, you can have CK included in the new virtual blockchain. When you deploy the virtual blockchain, you can have native payment. EVVM is just like a set of contracts that you deploy in a blockchain. You can deploy like this set of contracts in Ethereum, in Base, in Celo, in any blockchain that you want to deploy. And when you deploy this set of contracts, you deploy like a new environment. You configure how the things are going to happen. So you can put your own rules. So if you, let me go to the next one, because this is better, the best way to explain. Like, imagine you are a bank and you wanna have like a whole environment to be able to do transactions fully compliant with KYC, and you don't want users to pay gas. So for that, you have to do a lot of things. You have to do a lot of things in the UX part. You have to deploy a lot of contracts. And for you to be able to do this in a new chain, so you will need to build a new chain.